Good morning. I'm Julie Hyman with Brad Smith. This is Yahoo Finance Live. Let's get right to the three things you need to know to start off your morning. First thing you need to know, the Treasury stands ready to intervene if more small banks run into trouble. That's according to comments that Treasury Secretary Janet Yellen is due to make before the American Bankers Association later this morning. Meanwhile, officials are mapping out how to expand FDIC insurance to cover all deposits. That's according to Bloomberg. A coalition of mid-sized banks are behind the push to lift the $250,000 limit, saying it's needed if the banking crisis continues to grow. Second thing you need to know, global officials' attempts to attack the banking crisis has brought some stability to markets, at least for now. The Stoxx Europe 600 trended upward at the open, led by surging banking shares, and U.S. market futures are also trending upward. Plus, shares at First Republic Bank, they're surging in pre-market trading on a Bloomberg report that JPMorgan Chase could aid the flailing regional bank. All of these moves could change, of course, depending on what the Federal Reserve does with interest rates. It begins its two-day meeting today. And third thing you need to know, former President Trump says he could be arrested as soon as today. The possible indictment stems from his alleged role in payments made to adult film actress Stormy Daniels during the 2016 election. If he is charged, it would mark the first time ever that a criminal case against any U.S. president has been made. Trump, who has denied any wrongdoing, called the ongoing litigation, quote, an extortion plot. Well, in prepared remarks, Treasury Secretary Yellen has said the government is willing to backstop more deposits if smaller banks start to flounder. She defended the Treasury's intervention earlier this month in the wake of Silicon Valley Bank's collapse. She will make her full comments on these topics due at 10 a.m., Brad. And, kind of came out again. There is this coordinated effort seemingly by regulators, right. Treasury, FDIC, Federal Reserve, the message being, we gotcha.
Right.
The market has believed that in fits and starts, but it seems to believe it today.
Yeah, we got y'all, as Issa Rae would say in Insecure on HBO. At the end of the day, one of the things that they did put within the statement, or at least Treasury Secretary Yellen did, our intervention was necessary to protect the broader U.S. banking system. Similar actions could be warranted if smaller institutions as well suffered deposit runs, and that pose a risk of contagion. And when you think about what a deposit run looks like, look no further than what we saw with First Republic. They had $70 billion worth of deposits pulled from the bank, 40% of the total deposits. That's according to the Wall Street Journal reporting that had come out. And Yellen, for what they added within the statement from the Treasury side, I believe that our actions reduce the risk of further bank failures here, which is something it will be interesting to see if the Fed addresses that within their own commentary, their discussion, and within the ultimate decision once we get some of the commentary around that.
Yeah, so that's sort of that portion of it. Then you have the FDIC reportedly considering raising that cap on insurance, deposit insurance above $250,000. It is a move that some in Congress, particularly Republicans in Congress, oppose. So we'll see if it does end up gaining any traction. I mean, right now, you effectively have an implicit guarantee because of what happened with Silicon Valley Bank. But the question is, will the FDIC make it explicit? Will they extend it to other depositors as well? And I guess it depends on, we keep saying if it's necessary, if this contagion grows. We haven't necessarily seen evidence of a deposit flight that is widespread.
Right.
But it's also difficult to tell what's going on inside some of these banks.
Yeah, it's extremely difficult. And I think for some of the banks that have kind of formed this consortium to invest $30 billion into First Republic, they're also trying to put their best minds forward to say, okay, here are some of the solutions that we can help craft to get you to the other side of this as well. JPMorgan, one of those, of course, that has been involved within those conversations. So that particularly is going to be of interest to see where they move forward in those discussions as well.
Yeah, and just once again, to put a fine point on what we're seeing in First Republic, which I think is a pretty extraordinary part of all of this, with reportedly Jamie Dimon of JPMorgan once again spearheading the push to help the bank and seeing it surge this morning. PacWest and Western Alliance extending some of their gains from yesterday. And I guess the question becomes, is it just deposits, or does it become something more in terms of aid from the other banks? I don't think we have the answer to that question yet. Right. And again, will it even be necessary? We don't know yet, but there's a lot being thrown at these issues.
Absolutely. Well, one of the other big stories that we're tracking for you here this morning, investors anxiously awaiting for the Fed's policy meeting. That kicks off today, two-day meeting, of course. The central bank faces a pivotal decision for another big interest rate hike, or whether it's time just to hit pause or take a time out. Let's welcome in JPMorgan Asset Management Global Market Strategist Mira Pandit to discuss. Mira, great to have you here with us and get some of your insights. What do they do from your perspective here?
Right now, the market is pricing in about an 80% chance that they do go another 25 basis points. That's potentially reasonable at this standpoint because we are still fighting inflation. We do believe that inflation is going to come down. It will take some time, probably longer than the Fed wants. But the Fed does have to weave this line between not wanting to seem panicked, wanting to maintain credibility. Maybe if they pause entirely, that might send some jitters through the markets to show that they're still worried about the situation at hand. But they really have to balance out this inflation fighting with financial stability. We would say that, look, financial stability is a lot more important at this point. When something breaks, you have to consider breaking, even if inflation is elevated, because it is on the way down. And there's a lot of evidence that supports the Fed should start winding down its Fed hiking cycle, whether it's the fact that 70% of the gains in CPI last month came from shelter, which we know is lagging. Without it, it would have increased about 0.2%. In the jobs report, when we think about wages, wage growth has rolled over again, about 0.2% increase on a monthly basis. When we look at consumer expectations of inflation, that dropped in the New York Fed's survey of consumer expectations to the lowest since May 2021. And then you fold in some of the banking instability, and we've seen financial conditions really tighten pretty dramatically over the last couple of days. So irrespective and including some of the challenges with the banking system, it probably makes sense for the Fed to get closer and closer towards a pause.
Let's talk about the backdrop in terms of sentiment while all this is going on. Your peers over at Bank of America out with their monthly fund manager survey. Sentiment is pretty bad. If you look at the fund manager survey, investors' perceptions of risks, it worsened this month. Pessimism is close to where we typically see market bottoms, although they say some of their other indicators don't necessarily show a bottom right now. But what are you seeing in the indicators in terms of where the market is going to be tracking from here?
It's difficult to read the tea leaves right now because on the one hand, you do see that sentiment is very poor. And on the other hand, you see an S&P that is up for the year, considering everything that has happened so far and has been remarkably resilient. So investors are really holding on to some of those gains right now until we have further information. And what's so interesting is that usually markets do not like uncertainty. And in this case, markets seem to be taking uncertainty with a great degree of stride. Now, that's not necessarily the case in the rates market, where we've seen the most volatility since the financial crisis. So it's playing out more on the interest rate side as we try to peg exactly what the Fed is going to do. But within the equity market, you wouldn't necessarily know that investors are as pessimistic as they are right now.
Do you believe that we've bottomed out? I mean, the markets typically see that bottom prior to either a recession being entered or even the worst elements of that really being experienced. But again, the markets are trying to price this out well in advance of time. So have we already seen bottom, or do you believe that there's further declines to come still?
There could be some further declines to come from where we are today, but where we are today is actually reasonably far from where we were back in the fall. So I think that bottom is potentially in when we think about all of the things that we have been considering over the last year in terms of recession and how far the Fed goes. We're kind of getting to the point where we're realizing a lot of those realities, and there are surprises along the way. There's certainly challenges that we've seen over the last 2 weeks. But I do think that probably the market low is in there, but it doesn't mean we can't move a little bit lower from where we are today, which seems a little bit unsustainably high, because you also have to fold in, it's not just a Fed story, it's an earnings story as well. We've seen profit growth weaken. So I think that thread has been lost over the last 2 or 3 weeks as well, in that profits are still weakening, and that's going to put pressure on stocks as well.
Here's another disconnect in the market. You mentioned, of course, that stocks are up this year despite all of the sentiment. What's led them? Tech, which is also sort of counterintuitive, right? So the XLK, which we're showing right now, is up some, what is it on the year? Something like more than 10% here. So what gives? Is that something that is now vulnerable, even if the Fed is going to pause?
We have to be a little bit careful around tech stocks and really ground ourselves in valuations. Where do we actually see reasonable valuations? Where do we see a reasonable trajectory of profits? Look, to be fair, tech companies, especially mega cap tech, have gone through a year of reckoning in terms of what they can actually do from a profitability standpoint. Many of them are making prudent decisions as it comes to scaling back in certain places. We are getting closer to a Fed pause and probably at a lower rate than maybe we would have thought even 3 weeks ago. And you have seen, again, some of that valuation bubble come out of the system. So I think those are important points to consider. And look, people really look for some of the more defensive areas in times of stress. And tech has become a much more defensive area over the years when you think about some of these higher quality, essentially blue chip companies at this point. But again, we really want to, above all, in any asset class, ground ourselves in valuations where we think the prices are still fair. Where they're not is where we're vulnerable to correction.
One of the major themes that we had heard about starting out 2023 was healthcare. Does that theme still hold up even right now? I mean, the sector's been doing decent over the past kind of 1 week as we had seen some sputtering more broadly here. But even further as we get out into 2023, does that theme still hold as a strong play for people's portfolios?
It's somewhat mixed. Look, I think in the short term, it benefits from being a bit more defensive in nature. In the very long term, it benefits from having access to some of those longer term secular growth themes. But what we are hearing from a lot of companies is that they're still in this rock and a hard place between COVID is over, so we have less of a tailwind from some of those specific areas of medical care. And yet a lot of the elective surgeries have not quite picked back up. There's still a lot of staffing issues. So I think that some of the transitional pains are being experienced in the healthcare sector that might pose a challenge in the short run.
All right, Mira, good to see you. Thanks for coming into the
Thank
studio.
you.
We always
Thanks for having
appreciate
me.
that. Mira Pandit of JPMorgan Asset Management. She's a global market strategist there. Well, New York City bracing for a possible indictment of former President Donald Trump as soon as today over alleged hushed money payments to adult film star Stormy Daniels. The probe centers on a $130,000 payment that Trump's legal team made to Daniels during the 2016 election and whether he covered up that payment. In a tweet over the weekend, Trump said he expects to be arrested and called for protests. There is reporting that says he might be charged at the earliest tomorrow, so we'll be tracking all that, and we'll break down everything we know about the potential indictment later in the show with Semaphore founding editor-at-large, Steve Clements.
Amazon's latest announcement to lay off another 9,000 workers shines light on CEO Andy Jassy's time at the helm. Since his tenure began, the stock had its most rocky year since the dot-com crash. The company, they're implementing cost-cutting measures and deals with slowing revenue. Let's get to Yahoo Finance's Dan Halley with a deeper look. Of course, Dan, there are some broader sector implications that have really rattled Amazon at the same time, and they deal within a few different industries there. But within Andy Jassy's time as CEO right now, it certainly hasn't been an easy go of it by any stretch of the imagination.
No, not at all. And really what we've seen, Brad, is, the vast expansion that Amazon did during the COVID era and then following the lifting of lockdowns, kind of the degradation of what they had built up. Basically, they went out and hired tons of people. They were trying to build out new fulfillment centers and warehouses. And now they're basically left with too many of those, and we need to, or they need to cut back on them. So right now, what they're trying to do is find space for, or find uses for that space. And obviously now they're laying off people by the thousands. We had the original announcement that they had layoffs. They had the 18,000 back in January. Now they have the 9,000 that they've just announced yesterday. And really, I think what this says is that the company continues to have problems with the broader e-commerce landscape, as well as AWS, right? Their AWS kind of was their goose with the golden egg, and now we're starting to see a bit of slowdown there as far as sales go. So, that could go to discussions on interest rates. It could go to discussions on whether or not companies feel like they have the cash to spare, or if this is the right time to continue to build out their infrastructure. But really, the e-commerce aspect and the AWS aspect kind of colliding at one point with the overexpansion that they're dealing with. And look, Andy Jassy kind of summed it up saying, given the uncertain economy in which we reside and the uncertainty that exists in the near future, we have chosen to be more streamlined in our cost and headcount. That was in his email to workers yesterday. So, we don't know if we'll see anything further, but we have seen additional layoffs from other tech companies who we thought were only going to make one round of cuts originally.
Yes, this seems like a growing theme, doesn't it? Dan Halley, thanks so much. Appreciate it. We want to get more analysis of this Amazon job cut story, and not just that, the bigger picture for the company. Arun Sundaram is a senior equity analyst at CFRA Research. He maintains a buy rating on the shares in the wake of this announcement. Arun, thank you for being here. What does this tell us about Andy Jassy's leadership? I mean, yes, I know this is happening at other tech companies, but is this a referendum? Is this any kind of commentary on how he's been doing?
Yeah, I think, Andy Jassy took over Amazon at a pretty tough time. It was, I think, July of 2021 when Jeff Bezos announced this transition here. It was probably around 3-4 months after that announcement is when the macro environment started to go, a bit more south. So, and now, Andy Jassy, he's coming in and the strategy is really changing. Previously it was a grow at all costs model. And now the strategy has shifted to a grow at a more profitable rate model. And that's exactly what we're seeing happen today. 27,000 total announced job cuts. That's just one lever of these efficiency announcements that Amazon's announcing. They're also cutting some of their unprofitable businesses. We heard the announcement that they were pausing their construction of their headquarters here in Virginia. They're really looking at every nook and cranny to try to improve efficiencies and try to become profitable. Because you have to realize that even though Amazon grew massively over the past few years, they haven't been able to grow profitably. Their e-commerce business, the last time the e-commerce business posted a profit was Q3 of 2021. And the last time the international business posted a profit was Q2 of 2021. So it's been a few years since Amazon has been profitable in those businesses. It's really AWS that was really lifting Amazon over the past few years, but now we're also seeing AWS growth slow. So that's why these tough decisions have to be made.
Arun, within this effort to improve efficiency and really drive more profitability, I wonder where they're going to be looking across other elements of the business to decide where they need to do even more trimming or where they reprioritize or reallocate the capital or even the human assets that they can put towards it. And I think no further than, something that I wouldn't have known about unless Rod Breslau, who is known as Slasher in the gaming community, had flagged it to me via Twitter, saying that the Twitch co-founder, Emmett Shear, is stepping down as the CEO. And then they also announced 400 people are going to be laid off within the Twitch subdivision of Amazon. So what does that signal about where they are going to do more of the improvement of efficiency and in order to get some of the profitability that you're looking for?
Yeah, no, I think you have to realize that Amazon has a massive ecosystem of so many different products and services, some of which most investors don't even know about. And that's why it's tougher and it takes a longer process to really flush out all this whole new cost-cutting strategy. It takes time to go through different departments in Amazon to determine which ones do we still want to invest in, which areas do we want to cut back. And that's why I think we're seeing these different waves of job cuts announcements. The first one I think was back in November. Then we saw another round in January. And yesterday was the latest round. And this latest round is a little bit more significant because it is including some of Amazon's more profitable departments, namely AWS and their advertising business. But as you mentioned, also Twitch as well. I think another point I'll make is that Amazon does spend billions of dollars each year placing bets on certain businesses that may never become profitable. And I think this year, especially in light of the current macro environment, they're going to be placing less bets on those kind of businesses and allocating more of their resources to their core business and especially to the businesses that should grow profitably this year. Mainly, I'm thinking that e-commerce side, because like I said, e-commerce hasn't been profitable for several years now. And I still don't think we know the true profit potential for e-commerce, but I think this year we'll likely see the start of that path to profitability. And longer term, I think the margins could be attractive in e-commerce, but that will be more of a 2024, 2025 story.
Arun, do you think this is it? Do you think that there are going to be more cuts, not just from Amazon, but I imagine you track some of these other e-commerce and tech plays. Do you think there's going to be more waves of cuts as the year goes on?
Potentially, I think there could be more waves of cuts, especially if the macro environment continues to go south. We've seen the volatility in the market recently, especially in light of what's happening to the regional banking space. I think that places more risk of a recession later this year. And if that happens, I think we could see more job cuts throughout the internet retail space. I cover companies like Amazon, Chewy, Wayfair, Etsy. Many of them have already announced job cuts, but if consumer spending starts to really fall, maybe potentially the second half of this year, and demand really starts to fall, I think we could see more job cuts throughout the space.
If Andy Jassy is truly as kind of concerned or most prioritizing at least the most profitable elements of the business, what does that mean for the Amazon Prime entertainment side of their business, where you're talking about massive content spends in order to try and pull people back into the Prime ecosystem on the hopes that they would spend more, even if they are on a household level trying to trim some of their own costs as well?
Yeah, no, that's a good point. I think there are going to be areas where Amazon will continue to invest this year. And I think Amazon Prime is one of those examples. They've already put a massive investment in that space. You've heard about some of their originals that they've introduced last year. They had the deal with Thursday Night Football. That was a major deal, a costly deal. So I think they'll continue to invest in Amazon Prime Video, especially because that helps boost their entire e-commerce ecosystem. There are also other areas I think Amazon will continue to invest in. Healthcare is another example. They just closed on the One Medical acquisition about a month ago, and it seems like they're heavily invested in the healthcare space and trying to disrupt the U.S. healthcare sector. So those are just two areas, two examples of investments I think will continue in Amazon for 2023.
And it's so sprawling that I had momentarily forgotten about the healthcare stuff, Arun. Thanks for the reminder. Arun Sundaram of CFRA. Thanks so much for joining us this morning to break down what's going on with Amazon. Coming up, Credit Suisse can't escape the red, but wider European banks continue their comeback in the aftermath of that mega deal. We'll see if markets are feeling in a glass half full kind of mood and zero in on the banks in particular in a moment. We're a few minutes till the opening bell, so we've got some movers for you. One of them is right up there on your screen. It is Meta. The shares are up about 3%. That's after Morgan Stanley raised its rating on the social media giant, noting Meta's ongoing efforts to slash costs in its year of efficiency. And if that sounds familiar, well, it's because we were just talking about a similar theme at Amazon, because this is really the theme for large cap tech right now, Brad. And this note is interesting because obviously we knew that this was going on, but it's sort of a Morgan Stanley reassessment of this. The price target, by the way, going to $250. So it's a $60 increase for Brian Nowak over there at Morgan Stanley.
Yeah, I mean, for Meta and all of the spending that they have been extremely aggressive about within the metaverse, and how all of their different ambitions have started to dovetail even more so into what the hardware of the future of their platform might look like too. I think if there is any positive to come, at least early in this year, it is the efficiency that they're looking to drive right now, and that has gotten a positive review from the street thus far, and even more of kind of a positive note being signaled here, especially off of some of the lows that we had seen of late last year. I think perhaps the bottom could be easily set in for Meta here, given the move that we've seen over the past 6 months, and now even looking out towards the future and what the efficiency structure may look like, but then also how they're going to prioritize for their investors, just making sure that profitability is the chief priority, even as they navigate what is an uncertain, to say the least, 2023 here on an economic standpoint.
Indeed. And a couple of other interesting notes to pull out from Nowak's note. One of them is that it's not just a 2023 story for Meta. He thinks this is really a profound cultural shift at the company. And he had had a buy rating in the company for a while, downgraded it to equal rate in October, and now this upgrade is coming. He says the year of efficiency is more than just a 365-day change. It is rather a structural and cultural pivot to operate leaner and with a greater focus on investor returns, even through investment. So that's quite interesting here, that he does think it's a bigger change. The other really interesting things here, he thinks Reels is going to kill it. He says Reels is going to generate $18 billion in revenue in 2024, which would be more than doubling of its revenue this year. And then he's looking to this year for all overall Meta revenue to fall by 1%, but then grow 5% next year. So no, you're not buying it? You don't think Reels revenue is gonna make it there?
I don't know. I'm just like making my Chrissy Teigen face at this point, because Reels, for it to be as successful as they would hope that it would be, it would just ultimately need to be on the back of so many advertisers that continue to pile in and up their spending. And sure, for Meta and for Alphabet's Google, they have been the duopoly in digital advertising for years now. However, that's starting to be more challenged, where you've got TikTok that is crushing it on the in-app purchases side there. And of course, Instagram, the subsidiary of Meta Platforms, has been able to really grow out its own shoppability. I'd say they got me. So I made my first.
What have you been buying on?
I bought a sweater from Eastside Golf. It was a great sweater too, solid quality, great stuff, guys. But at the end of the day, it's at a time where so many advertisers and marketers are looking across where they're spending, where their dollars are going, and where it's most effective. Meta could continue to at least retain a lot of its market share, but it's in the face of even more competition right now.
Yeah, for sure.
Okay, this one I was excited to talk about. Shares of On Holdings. On Running, of course, they're to the upside right now by about 20% here pre-market after the Swiss sportswear company topped estimates in its latest quarter. Some of the stats here, they saw net sales grow 91.9% year over year as the outlook for 2023. That looks promising. It was a beat on both the top and bottom lines. And I would think that within this broader performance category, and sneakers as a whole right now, I think is seeing a little bit of a rebalancing of the priority in brands among consumers. New Balance, we spoke with their CEO just a few weeks back. They're doing stellar right now, both in the performance category as well as in the lifestyle category. Companies like On Running, you've seen those in more capacities now, even in offices or just in casual structures, and especially on the running side. And they've got good distribution, Foot Locker, so forth, other retailers. And then Brooks Running, we spoke with their CEO a few weeks back too. And so this just sets up for some of the non-Nike or non-Adidas or even non-Lululemon companies, even though Lululemon's fresh to that space.
Yeah, apparently their shoe sales have been doing well also. Yeah. So that's me to keep in mind as well. Yeah, I mean, it sounds like they're also fixing some of their supply chain issues that they have been going through as well. So that's something to note when it comes to On Running. And there we have the opening bell on Wall Street. As we check the markets, it's sponsored by Tasty Trade here as we look at a potential rebound this morning from some turbulence as of late. So we're looking at stocks to gain at the open. Bank stocks in particular, financial stocks have been coming back here this morning in pre-market trading on some commentary from Janet Yellen, of course, the Treasury Secretary. She's expected to speak at 10 a.m. and among other things say that the federal government stands ready once again to backstop the banks, particularly smaller banks, which she emphasized are important to the U.S. financial system. You see there, all three major averages opening higher and the Dow leading the gains up by 1%. Let's talk more about the banks, more about what's going on in today's session. Brad, you are standing by over there at the Interactive.
I am indeed. Yahoo Finance Interactive hasn't run away from me yet. So here we are at the open. The Dow Jones Industrial Average. We'll put this on a chart view for you and give you perhaps the past 2 days once it toggles over. Dow Jones Industrial Average holding up by about 1% out of the gate here. Past 2 days, net positive by a little more than 2%. Nasdaq Composite, you're seeing the tech-heavy average up right now by 0.9% to start off today's activity. Past 2 days, yep, positive. You guessed it, 1.25% there. And over the past 2 days for the S&P 500 early in this week, you're seeing it up by nearly 2%, 1.9% to be exact there. 1% added here early in today's activity. We're going to take a look at the sectors and then we'll get to some of those regional banks that were aforementioned. The 11 S&P 500 sectors here pulled up for you live in living color on your screen. We just had utilities flip barely into positive territory by the hair on its chinny chin chin, and that gives us all 11 S&P 500 sectors in positive territory, but now it's back in the red. All right, so you messed up my little flow there, utilities, but that's okay. We'll come back to you. Energy leading the charge. That's up by about 2.6%. We promised you some regional banks. We'll give you some regional banks. Taking a look at some of those regionals. You've got green across the screen in a broader rebound taking place here on the day. Let's take a look to see if we can find First Republic. Yeah, oh my goodness. Yeah, the biggest mover to the upside on those regional banks, but of course, because it was one of the biggest decliners yesterday there. You're taking a look at the past 2 days, still net lower by 32% over the past 2 days. However, here out of the gate this morning, it is up by
year to date as well.
Yeah, year to date. I'll pull that up for you as well here. Year to date for, oh my goodness, yeah, for some of those regionals. Yeah, and of course, the beleaguered Signature, and then additionally, of course, you saw Silicon Valley Bank also, which is just, it is where it is right now.
Yeah, it's not anywhere right now,
anywhere.
I think is the bottom line with that.
Yeah.
I mean, if you go back to today's session, though, in the intraday, it is interesting because we do have these reports now that JPMorgan is once again trying to spearhead some kind of effort, continuing effort, ongoing effort. You have that in combination with the Janet Yellen comments that the Fed is ready to help small banks in particular, and you have reports that the FDIC or legislators are considering pushing up the insurance limit for FDIC insured deposits above $250,000. It seems like all of that, perhaps, that concerted effort maybe has stopped the selling in First Republic. And just to be clear, when we talk about First Republic, we're talking about two different things here. We're talking about the market perception of the soundness of the bank on the one hand, which is represented by the stock price. And then we're talking about the deposits, right? We have reporting that there is our deposit outflows from the bank, right? But just to recognize there are two separate things. And this is something that was important, for example, at Credit Suisse. There's the soundness of the bank itself on the one hand, and then there is also the perception of the soundness of the bank, which sometimes is a very different situation.
And it sounds like other banks are believing that there is not a soundness of the bank, at least right now, which is why you have some representatives from JPMorgan trying to work with the bank and give them a little bit more of the options that could be on the table. Investment bankers hired and looking to advise First Republic on some of what those options might look like in the future, according to some reports. And then additionally here, the capital injection, it sounds like, could be more, or at least the deposits that had been put forward by the consortium of banks that could move into a capital injection. That is one of the options that they are also weighing as of right now here. So even as we're keeping an eye on First Republic Bank here today, which is up by about 29%, as we were mentioning, or 25% now, it comes as all of the regional banks seeing this kind of broader attempt to bounce back in the face of lower sentiment that we'd seen over the past couple of
And the
weeks.
big banks as well. We have been seeing some recoveries there. I mean, it's interesting to see that gain across the board. I think we have UBS there is up some 7%. You know, we talked a little bit about this yesterday. It was down and then it went higher. And you had mentioned, usually you see the acquirer go down.
Yeah.
The acquirer usually goes down in part because people think they're paying too much for it, which is not probably the case for UBS buying Credit Suisse. So it's up for the second straight day.
Yeah, it is a steal, and because of how beleaguered and the panic that really ensued in order just to make sure that Credit Suisse was able to have some type of buoy. But now, of course, the buoy in UBS and what they're acquiring here, it's the sunsetting of certain divisions, at least in the kind of integration of that business and what that could look like. And of course, the extreme depression of their actual valuation coming into that deal too. So UBS, they certainly got quite the acquisition that they were able to bring on. It's just about what that trimming looks like once they start to really integrate the two businesses as well. Awesome. Let's talk a little bit more about what else we're watching today. Watching shares of Tesla after Moody's upgraded the EV maker's credit score after S&P Global Ratings made a similar move in October. Yahoo Finance's Frost Supermania has the details in the next hour. But coming up after the break, gold hovers near 2,000 as investors look for safe havens. Yahoo Finance's Nez Perez got the deets next.
The Federal Deposit Insurance Corporation, or FDIC.
FDIC. The FDIC.
The FDIC.
The FDIC, the Federal Deposit Insurance Corporation, was established during the Great Depression to restore our faith and our trust in America's banking system. But what does it do?
Its job is to protect your deposits that you put in regulated banks. Regulated banks will have a sign that says FDIC insured, and it will also say what the deposit limit is. The current cap is $250,000. The FDIC has a perfect record of protecting insured deposits. Not only that, but the policy has been, we did it every single time during the Great Financial Crisis. You'll have access to your insured deposits within one business day if your bank fails. For those who have more than $250,000, though, they should be aware that if the bank fails, they may not be protected.
So how do banks turn a profit? Well, they keep a portion of the money you deposit as cash or reserves to handle those day-to-day withdrawals. But the majority of your money is invested, and it's invested in mortgages, car loans, treasury bonds, the list goes on. And they make their money from the interest that's earned on those investments.
But sometimes banks do stupid things with your deposits. Yeah, doesn't happen very often, but sometimes it does. And that's why the FDIC is there. If the bank does stupid things with your deposits and loses too much money and becomes insolvent, the FDIC is going to swoop in and make sure that your insured deposits are whole.
Gold is hovering close to 2,000 as investors flock to precious metals amid market turmoil. Yahoo Finance's Inez Frey's at the Wi-Fi Interactive with more. Really interesting, Inez, because gold's sort of haven status didn't necessarily hold up all through the pandemic, yada, yada, but now it's definitely coming back into vogue.
Yeah, that's right. And there's a couple of reasons for that. One is that investors may be believing that the Fed is nearing the end of its tightening cycle. The other one is that inflation still is elevated. And then, of course, you also had the banking crisis. So that definitely, I was speaking to a strategist saying that definitely saw flows of money going into gold, seen as a safe haven. So over the last month, I'm going to pull up a monthly chart so you can see gold up 7%. It was yesterday around the $2,000 level. Now, the gold hasn't seen these prices since March of last year, of 2022. So if you just take a look, I'm going to put up an intraday chart. It's right now at $1,965. Now, the previous high was $2,074. I spoke to a strategist saying that he believes that this year you may see a little bit of a pullback at first, but then he thinks that the gold will go to 2,100 this year. But it's really next year in 2024 where gold is expected to go to. Some strategists are saying 3,000 an ounce, 3,500 an ounce. Now, if we just take a look at silver futures, silver is at $22.56 an ounce. As far as silver is concerned, if there is a recession, I am told silver may not perform as well as gold would perform because silver is used in the industrial sector. So that would be a reason why silver may not initially perform as well, but over the next 3 to 4 years also, precious metal bulls are saying gold, silver, these are safe havens to go to, guys.
Interesting stuff. Thanks so much, Inez. Appreciate it. We've been watching those metals closely. Coming up, walking the tightrope, fighting inflation is hard enough without worrying about imminent risks to the financial system. It's not a great position for the Fed to be in, or is it? Your morning brief is next.
We all know the FDIC protects your bank deposits up to $250,000. But what if you have your money in a brokerage account or even a credit union? We asked Bankrate.com Chief Financial Analyst Greg McBride.
If you have money in a brokerage account, this is something different from the FDIC insurance you have with your bank. brokerages, if they belong to the Securities Investor Protection Corporation, they have this SIPC insurance, and that'll protect you up to $500,000 in losses in the event that the brokerage firm goes out of business. Now, that just protects the fact that your securities won't be part of that liquidation. It does not protect you against investment losses, and that's a key distinction. The value of your account's going to fluctuate. SIPC insurance doesn't protect you against that. If you have money with a credit union, this is likely federally insured as well. The National Credit Union Share Insurance Fund provides, similar to the FDIC, $250,000 worth of coverage to credit unions. Before you put your money in a credit union, just make sure that they are protected by that National Credit Union Share Insurance Fund. Just like with a bank, you want to make sure you're putting your money in a place that's federally insured. But as long as that's the case, you are protected up to $250,000, just as you would by the FDIC at a bank.
Well, in times of financial volatility, a key job for any central bank, besides promoting stable prices and full employment, is to maintain the stability of the financial system by trying to contain any risks. With the latest turmoil in banking, the Fed is once again confronted with the need to ensure financial system stability, while at the same time trying to keep a lid on inflation. You can read all about this in today's morning brief up on the Yahoo Finance homepage, which I authored. For more, let's welcome in Robert Tipp, PGIM Fixed Income Chief Investment Strategist. Robert, thank you so much for joining us. So the Fed is confronted with a very similar decision to what the ECB was confronted with last week. Do you keep your inflation fighting hat on, or do you put your financial stability ensuring hat on? The ECB chose inflation fighting. Do you think the Fed is going to do the same?
I think the ECB actually had kind of a little bit more of a subtle, balanced approach in some respects. They did hike rates, but they had signaled previously they were going to hike rates, and after they hiked rates at that meeting, they expected to hike rates again. And what they did at the meeting was they completely pulled their forward guidance. And so I think the Fed is likely to take a similar kind of step, except they may not hike. The Fed is quite a bit ahead of the ECB. They have hiked quite a bit more. And so they may pass on this meeting. And in fact, the Fed, in contrast to the ECB, in their December projections had suggested, they were going to hike a few times this year. They had 8 meetings. So there was an implicit plan there that they were going to be skipping meetings. This would be a good meeting for them to skip. So I think they're going to keep the underlying, we will solve the inflation problem. But job number one that's kind of crept in here on the side is don't kill the patient. And so that requires a little bit of patience, a little bit of a more subtle approach.
But for the Fed to even pause, it would imply that they'd seen something in the data where we already know that they haven't met either their inflation target, even as employment has held steady to this point in time. So they've been able to look to that for some of their own aggressiveness to continue to proceed forward. But what would it say within what they have seen such to this point that looks dire or looks more extreme to lead them to pause at this point?
Right. Well, I've seen a few cycles in the last 40 years. And in the 94 cycle, they hiked at an accelerating pace. And what you find out is not only do you find some fragilities and that some things can break, but you also figure out that really a more sensible approach is the further you get in the cycle, the slower you go, because they are seeing things. Yes, it's true. The inflation is still high. They're seeing some signs of moderation, but not enough. But they have seen a dramatic slowdown in the residential housing market. Now they're seeing some congestion in the commercial real estate market. Now there's expected to be some retrenchment in commercial and industrial lending by smaller and mid-sized regional banks to smaller and mid-sized companies. And there could be some anxiety created by the stresses that we've seen in the market. So they have a lot of things that would suggest to them they should slow down, and that the more restrictive you get in terms of policy, the slower you get. That's how you get a soft landing and you avoid some kind of a serious mishap.
As I look at the Treasury market, it's interesting the real drop that we have seen in a lot of yields, partly because of what's been going on in the banking system, of course, Is this also a reflection of the belief that the Fed, even if it raises tomorrow, is going to have a lower terminal rate than previously expected?
Well, I think yields have come down, and the immediate market move is one to drop real yields and leave the inflation up. Because if the Fed is taking their eye off of, in some respects, the inflation target and working on financial stability, that is easier policy. That's a lower real interest rate adjusted for inflation. I think the fact of the matter, though, two things worth pointing out. The first one is the Fed had a single mission in this assignment so far since Powell's reappointment, which was get inflation down. Now they clearly have a slightly broader mandate, and that is going to mean, in my opinion, a more cautious Fed and one that is more likely to foster a longer economic expansion and a slower return to inflation, a slower return to the inflation target, right? So by having a little bit of sickness here, that may extend the life of this expansion because the Fed is going to be more cautious. I think big picture, though, the thing for people to not miss is that while interest rates have gone down, spreads have moved wider. Corporate spreads have moved wider by about 40 basis points. Treasury yields at this point have fallen by about the same amount. The big picture is that, 2 years ago, the Treasury was yielding 1.5%, and corporate spreads were at 80 basis points. Now, you're up in the mid threes. The credit spreads are up in the 1.5%. You have a really wide strike zone for fixed income here, and people should be thinking about, fixed income in a completely different light than when they thought about it from 2012 to 2022. It was a little bit less competitive. It was an increase in yield relative to cash, but you're in a low yielding environment. Now you're in a significant higher yielding environment. It's much better for fixed income investors, but it's also one that's going to engender a bit of more caution from the central banks at this point.
From an investment strategy perspective, perhaps investors out there not trying to fight the Fed, but they're trying to anticipate the Fed best. What is the best portfolio maneuvering that they could perhaps anticipate and ultimately enact or employ right now?
Right. Well, I think, people have to look at what's their highest information ratio activity? Where is their edge? Is it in calling the short term? Is it in calling the intermediate term or the long term? And, over the decades, what I've seen is these secular trends can be, in some respects, easier to identify. And I think we have shifted to a higher neutral level of interest rates. We've gone from a secular declining rate environment for the last 40 years, where every cycle had lower lows and lower highs and then a very low range. I think we've popped up into a higher range that is going to turn out to be neutral. So I think the main thing for investors here is to not get wrong-footed. What we've seen historically is that long-term fixed income, even intermediate-term investment-grade fixed income, outperforms cash over the long run. We've had incredible growth. We've had incredible inflation. 5 to 10 years down the road, nominal growth, that sum of growth and inflation is going to be lower. Rates will probably be lower. The curve will be steeper. And over that time period, long-term fixed income is going to outperform. Now, if you're more optimistic on the economy, I would argue high yield is probably going to do very well. And if you're more worried about the Fed raising rates still, which I think is valid, then your intermediate term investment grade may be your best option there. But I think a balanced approach to fixed income here is going to have very good results over the next 10 years from this level of yields. That's the big picture. And I'm guessing that's where people are going to have the most success in looking for answers here.
Certainly there is a lot of enthusiasm over the sector for the first time in a long time. Robert Tipp, thank you so much for being here. PGIM Fixed Income Chief Investment Strategist. Well, coming up, shares of Digital World Acquisition Corp, or DWAC, are acting as an interesting gauge of sentiment around the former president and whether or not he gets arrested today. The shares soared yesterday. Today, they're moving down by about 0.5%. Let's take a look at one trending ticker we are watching. Digital World Acquisition Corp. The stock is down just about 0.75% today after former President Trump said he could soon be indicted for allegedly paying Stormy Daniels a payment of $130,000 during his 2016 presidential campaign and then covering it up. The shares have seen volatile swings since the announcement. They were up a lot yesterday, and today they're not doing a lot.
Coming up, the aftermath of SVB's collapse. There you're taking a look at some of the big banks on your screen. We've got much more as we strike the top of the 10 a.m. hour, just 90 plus seconds away. Welcome back to Yahoo Finance Live this morning. I'm Brad Smith alongside Julie Hyman. Markets this morning are holding on to gains across the major averages in the U.S. The Dow, the S&P 500, and the Nasdaq hitting the trifecta, the hat trick, the triple double, whatever you want to call it up across the board in the green. Dow up 0.9, about 1% almost. S&P 500 a little bit more than 1%, as well as the Nasdaq Composite about 1.2%. But we've got some breaking economic data, and
yes,
I'll toss it on over to Julie with that.
We're talking about existing home sales here rising, snapping a long losing streak, up 14.5% in February. Remember, these are a bit of a lagging indicator. 14.5% in February to an annual pace of 4.58 million. The losing streak that had been ongoing for existing home sales, it had been going on for a long time, a record decline in terms of the number of months. And now we are seeing this biggest advance since mid-2020, that 14.5% increase. So quite interesting here. The National Association of Realtors chief economist saying, conscious of changing mortgage rates, home buyers are taking advantage of any rate decline. So we have seen rates come down a little bit, Brad, and it sounds like that is drawing some people back into the market. Really interesting here.
Yeah, and the price at which the buyers are paying and where they're coming into some of the financing options that are out there, which of course elevated from a few years back. But at this point, as you continue to watch closely what the median home price, existing home sales price is, that's where you might start to get a little bit more of an inclination for buyers to start to come back, and for sellers as well.
And guess what? There was a decline in the median selling price, the first time in 11 years that we've seen a decline. The decline wasn't big. It was only 0.2%, but the median selling price of a previously owned home now $363,000. So again, down 0.2% year over year. The first decline in 11 years. It's surprising. It's surprising and interesting given this environment because there's still not a lot of inventory on the market. Number of homes for sale at 980,000, which would take 2.6 months to sell all of the homes in the market. Anything below 5 months is still a tight market. And just anecdotally, it sounds like inventory is still pretty tight out there. Anyway, it's interesting stuff.
Well, yeah, it is. And it sets up for what we're going to get later on this week. We're going to get some new home sales data as well. For that, it might be interesting to track, or a big week just to keep a close eye on the home builders ETF for the S&P 500 XHB, which actually took a little bit of a move higher, even on this existing homes data by about 0.5% here. So continue to watch that as we move on throughout the rest of the week as well.
Well, turning back now to the failure of Silicon Valley Bank, which opens a new threat to the health of community, mid-size, and regional banks as a fundamental shift may be on the horizon for the American banking system. Here to break it all down is Kevin Green, Tacit Chairman and CEO. And this is something that Janet Yellen talked about this morning as well. Kevin, thanks for coming in. The Treasury, I almost said the Fed, thinking of her old position, that the Treasury stands ready to support these kinds of banks. You just wrote an op-ed recently on this very topic. And this is something that's been discussed a lot, that all these deposits are now going to flow to the big banks. What is the risk here?
The risk is that the trend that you described continues. The current shakeup has created a lot of doubts about small and regional banks, and it would be a tragedy if those banks went away. We're really at a crossroads here in the banking industry, which is that is our model for the future increasing dominance by a handful of banks, what I call the European model. That model has been proven not to be good in terms of productivity, economic growth, and innovation. Or can we preserve what's been the strength of the U.S. economy, which is small and medium-sized banks operating in local communities close to small businesses, close to small borrowers, able to serve them well. And calling into question those banks is really problematic.
Now, you actually, at Tacit, you work on blockchain-based instant payment networks for banks. Did you work with any of these banks?
So we were a provider to Signature Bank, their Signet platform. Our platform, look, the way the world works right now is that B2B payments are moving towards real-time, around-the-clock infrastructure. The way I describe it to people is everything all of us do throughout our day is instantaneous, and it's around the clock, except for one thing. If you're a company, you want to move money within a bank, you've got to only do it 40 hours a week, and sometimes you have to wait days. That's going to be changing. So our platform enables that to happen. And we're particularly focused on empowering small and medium-sized banks. That's our purpose. Now, those banks originate 60% of all the small business loans in America, 80% of all the agricultural loans. So we try to empower them with technology to compete on a level footing. In fact, we think they can outperform the mega banks. And without that technology, it would be difficult for them to do that.
So how many small and mid-sized banks are you working with right now? And I'll hold my next question until you answer that.
Go ahead. So we're right now empowered in several banks currently. We've got a working group of about 50 banks, a pipeline of about 70 banks. So we're still relatively early in our process. But what we're seeing is that when those banks actually provide this capability to their customers, so think about most customers, they can only operate 40 hours a day. It breaks down regularly. Our platform operates around the clock flawlessly. Once those corporations use our platform, they don't go back to doing it the old way. So the beauty for the banks is that their customers love them. Really, they develop deeper relationships. They're providing a service that actually the mega banks can't perform now. And it allows them to grow their client base, their customers, the deposits they've got, and how they interact with those banks.
Yeah, I mean, even at a big bank, a wire transfer is a pain to execute.
Correct.
I guess I would ask, though, yes, we see that there's this perception of trouble at regional banks, but are regional banks really going? Are small and mid-sized banks, is there really a threat to them right now?
Well, historically, we've seen a tremendous consolidation of banks, so there really is an issue of how many banks will remain. Secondly, it's a real question in a lot of people's minds, given that you've had pretty significant banks fail. People reasonably asking themselves, is my money safe in a particular bank? That's a real issue. I'm actually very pleased to see that Janet Yellen has said they are trying to do whatever they can to keep those banks that have gotten in trouble preserved and not have them swallowed up by the big banks. That's a real positive. It means that she and other policymakers are paying attention to the need to preserve the diversity of the U.S. banking system, which is really important.
Given the partnerships that you do have with some of these banks, as you mentioned a moment ago, has there been an interim or material impact to your business right now?
What we've seen is actually it's been a positive for us, that I think the banks are starting to realize that technology really does matter, that they really do have to upgrade, that they have to get more competitive. They have to offer their customers more than just deposit your money with me. They've got to offer them added services, added capability, and real-time payments around the clock that are safe and secure is what every corporation is looking for.
There's not a lot of companies that are doing what you're doing right now, right? I mean, Signature was doing something similar, if I understand it correctly, or were they working with you? Can you explain that to us a little bit?
Yeah, so it was our technology that was powering Signet. So that was our relationship with Signature Bank.
Okay, gotcha.
But there are not many other players out there. We expect there will be over time, but we've pretty much got a pretty big position right now. We're going to keep growing it. But we expect competition.
Well, we'll check back in with you as that develops. Kevin,
Great.
Thanks for being here. Kevin Green, Tacit Chairman and CEO. Appreciate it.
Great. Thank you. Thanks.
Well, Treasury Secretary Janet Yellen is indeed speaking before the American Bankers Association in Washington, D.C. In comments that were released ahead of her speech, she's expected to say the Treasury stands ready to intervene if more small banks run into trouble. So far, she said the actions taken were essential to prevent further bank failures, and she says the recent developments were very different to those of the financial crisis. We'll be monitoring her commentary and checking back in. Well, coming up next, we will be checking in with Adobe. Adobe shares have had a few good months. The company recently beat the streets with their first quarter results. Now it's making a big push into the AI space, in particular, AI for enterprise. We'll be right back.
TikTok is on the verge of being banned in the US, meaning your days of endlessly swiping on the platform may be numbered. Of course, there's also a couple of conversations to be had about First Amendment rights, data privacy, and what this means for competitors like Meta and Snap. But let's just start first with how we got here. TikTok wasn't always TikTok, at least not exactly. Back in 2014, Alex Zhu and Liu Yang launched Musical.ly. The app became incredibly popular among US teens and tweens who would use it to lip sync to songs. Sound familiar? ByteDance, meanwhile, was already running TikTok, and seeing how incredibly popular Musical.ly was, decided to vacuum up the company for $1 billion in 2017. It then merged the two in 2018, forming the TikTok we know today. But TikTok's connection to China, coupled with the fact that it's so popular with tweens and teens, sent US lawmakers and regulators into overdrive. It's not as though the app has been without its controversies either. In 2019, it paid a $5.7 million settlement to the FTC over allegations that it violated the federal Children's Online Privacy Protection Act. But the government's main beef with TikTok is over whether it collects US user data, which it can then ship to China and spread pro-Beijing propaganda or spy on Americans. A number of states, federal agencies, and even the military have already banned the use of the app on official devices. Former President Trump attempted to ban the app via executive order, but was shot down in the courts. Oracle then said that it would move US user data to servers based in Virginia run by Oracle. For its part, the Biden administration has been negotiating with owner ByteDance for months, but the two appear to be at an impasse. Now Biden's throwing down an ultimatum. Either sell the app or get out of the US. If that doesn't work, there are a number of bills circulating around Congress aimed at killing TikTok. It's not as though the US is the only country that's trying to ban the app either. In 2019, India outright banned it from its citizens, and both the UK and Canada have banned it on official devices, as has the EU. Where do we go from here? Well, Trump already failed at trying to ban TikTok, so it's hard to tell whether or not Biden will succeed at the same task. Either way, whichever party does ban it is sure to face backlash from younger voters.
Got a quick check in the markets now, sponsored by Tasty Trade. About 40 minutes into the cash trading session today, and the Nasdaq is leading the gains. It's up by a little more than 1%, but the S&P is keeping pace right there with it. The Dow higher by 0.8% today. No surprise, the best performer in the S&P 500 today is First Republic Bank. A lot of the other regional banks are also following suit there, but we also have some strength in the technology companies, and that's why we see the Nasdaq up as well. And speaking of technology companies, let's talk about Adobe. It's betting big on artificial intelligence like many other big tech companies right now. The software giant announcing new generative AI innovations are going to be added to its cloud services at its Adobe Summit today. Adobe Digital Experience Business President Anil Chakravarti joins us now. Anil, thank you so much for being here. What's been interesting is, those of us in the press and I think in popular culture are very excited about the likes of ChatGPT and consumer-facing AI. You guys are looking at the sort of enterprise potentials for AI. So talk us through how you are approaching that.
Thank you for having me on this morning. When you think of generative AI has the potential to transform what marketers and creative professionals do and actually how they do their work, make them much more productive and creative. So what we're doing is applying the same kinds of technologies you mentioned, like ChatGPT. We're applying them in the context of how marketers can do their work. For example, it acts as a co-pilot to help them with their copy generation. If you're writing a marketing blog or if you're writing a data sheet, you can start writing it and it'll complete it for you. Those are some of the examples of what we call the Sensei generative AI services that we launched today.
And so you launch these services, I mean, they're not going to be free. Of course, there's a lot of work that goes into that. So how does this add on to the value that currently exists within the Adobe broader cloud or suite of offerings that you have, and what the customers, the portfolio of clients that Adobe has, what they can expect to be an incremental, perhaps, cost that they have to consider with regard to some of the services that they do pay for, and this add-on of generative AI within those services?
Yeah, so when you think about what marketers do and creatives do, a lot of the work today is on personalization. Every customer in every industry expects their services, especially their digital services, to be personalized to them, which means the content needs to be personalized, the messages need to be personalized, the offers you put in front of them need to be personalized. That's a lot of work. So therefore, when you look at the amount of demands on content, we have seen that double over the last couple of years. And we did a recent study that said it'll increase by 5x over the next 2 years. The only way to make that happen, if you're a marketer, if you're a creative professional, you're not going to get those additional resources in your teams. You need the power of technology to amplify and make you much more productive. And that's what the Sensei Gen AI services do. Act as your co-pilot so you can be a lot more productive and personalize messages, personalize offers and content to your customers.
And Anil, sort of to put a finer point on what Brad was asking, how much do you expect, how much in revenue do you expect from this product? And more broadly, AI-related products, how much of a chunk of business do you expect from that for Adobe in, say, the coming year, 5 years, et cetera?
Yeah, so we actually are building it into our current products and our workflows. So we're not going to monetize the generative AI separately. It is included as part of our product. As you mentioned, there is a cost to it. But one of the things that we have delivered consistently is a track record of innovation across our products. So if you think of a product like our Adobe Experience Manager, which is the leading product for managing content for our enterprises, many of these Sensei generative AI services will be bundled in as part of the Adobe Experience Manager. And this is a recurring revenue product. As customers use more of the product, as they consume more, we actually monetize it through those additional consumption that customers have.
We had a call come through earlier today talking about Meta and how well that's going to be doing with Reels, or at least expected or anticipate to do with Reels here. And I think about the number of Adobe clients out there that are leveraging, one of the different suite of products that you have. How many of those clients would you say are creating content specifically that is going to go into a social media feed via a Reel versus via, an AI generated just image of me that I could post?
Yeah, I think we're going to see a complete mix of that. If you look at different industries, for example, you think of retail industries and where they are trying to reach their consumers, whether it's travel and hospitality or a banking, they invest in a mix of different kinds of media, including obviously social media. They also have direct advertising that they do. They also have their own owned media that they publish through. It's a combination of all of those. So when we think of generative AI and how that applies, it is content for all of those different kinds of channels. So for example, what you were just talking about, if it's a video like through Reels or through YouTube, et cetera, you can actually generate specific content that can go either as an ad or as a promotion as part of that channel. So we're going to see a mix of all of that. And we have a pretty diversified customer base. So the core technology we're building can be personalized and customized based on the industry and based on the marketing mix.
And Anil, maybe this is a little bit of a cynical question, but I mean, is the AI opportunity one for you to upsell your clients, and or is it that they are clamoring for these kinds of tools?
They are really clamoring for these kinds of tools. The demands on marketing and creative content production have just exploded. As customers shift from one-to-many communication to more and more one-to-one type of communication, the needs for content and very specific images, videos, text has really exploded. And the only way they're going to keep up is by integrating all of these generative AI services seamlessly into the workflows that they currently have, because they can't change their workflows completely. They have to integrate it into what they're currently doing.
When you think about the digital experience for customers, there used to be, of course, this phrase, the digital body language, or the terminology, the digital body language, that a lot of marketers would leverage in order to create a better customer experience, a sales cycle, whatnot. And email marketing was at the top of that for so long, alongside, of course, so many of the internet ambitions. Now the mall has shifted towards your social feed. And so if that is the case, what does that mean for Adobe and how marketers that you work with, how different companies that you work with are reprioritizing the different parts of the suite that they're spending on? And is that net positive or net negative for Adobe?
It's a net positive for Adobe. When you think of the different channels of engagement we have, it has now become a complete mix, and you have to keep the customer at the center. You mentioned social. The web presence continues to be extraordinarily important because that's your own media. And if you get a customer there, you really control the message. Mobile is huge. Mobile consumption, both of emails and through the apps, is huge. And then what customers are doing, our enterprise customers are doing, is how to digitally enable every other channel that they have, in store, in venue, on location, in product, whether they have digital products. For example, if you have you're an EV manufacturer and you have an app that your consumers are using, you want to really personalize that app. So all of these channels need to be connected, and that's what we do with our technology.
All right, I don't miss my days of marketing automation campaigns, but at the end of the day, it's fun to rehash some of these conversations. Adobe Digital Experience Business President Anil Chakravarthy, thank you so much for taking the time here today. We certainly appreciate it.
Thank you very much for having me.
Absolutely. Guys, coming up, is an arrest or indictment nearing for former President Donald Trump? And if so, what's the material impact? We're going to take a 20,000-foot view of the situation and what it could mean for political stability in next year's election. That's next.
Former President Trump says he'll be arrested today. He's called on supporters to protest, but the Manhattan District Attorney's Office has yet to announce when or even if they're going to issue charges over alleged hush money payments and the cover-up of them. Let's take a step back to understand the potential charges Trump is facing. At the center of this, a $130,000 payment that Trump's former personal lawyer, Michael Cohen, made to adult film actor Stormy Daniels in 2016. The payment was made in exchange for Daniels' silence about an alleged affair with the former president. To be clear, the hush money payments themselves don't seem to be illegal, but prosecutors allege that when Trump's company paid Cohen back, those payments were wrongly labeled legal fees. Misclassifying expenses is illegal, in New York State. Trump has denied the affair with Daniels, and he calls the Manhattan DA's investigation a witch hunt. All of this as Trump seeks the 2024 Republican nomination for president. I'm getting major flashback vibes here. Joining us to discuss what a possible indictment could mean for the former president is Steve Clemons, founding editor-at-large of Semaphore, and Yahoo Finance's own Rick Newman. Steve, let's start with you here. First of all, the president says he could be indicted as soon as today. It seems like other reporting is indicating it would be tomorrow at the earliest. Are we falling into the Trump trap once again?
Maybe just a little bit, but you got to give him credit for taking over the news cycle, for creating a dividing line for other GOP pretenders to the throne who would love to run for president, forcing them to say whether they're on his side or the side of, New York's district attorney. And so anticipating that some form of legal action might take place and that he might be in legal peril, Trump grabbed the headlines and, created real political peril for his opponents and created sympathy for himself nationally, regardless of whether it is true, which we now know is probably not likely true, that he would be arrested today, but that may come later in the week.
What do I think?
Yeah.
Well, Trump looks like he's actually going to be wrong about the timing. It looks as if it's not going to happen today. So in one sense, he stole his own thunder by getting the date wrong. Let's say this does come later in the week. It's a huge political story because it would be the first time prosecutors have ever indicted a president or a former president. I think maybe the political analysis here is a little bit overblown, believe it or not. As you were reading this, giving the introduction, the background of this case, Julie, everybody who follows President Trump is familiar with this. There's really nothing new about it. So political analysts are very busy trying to figure out, does this help Trump? Does it hurt Trump? I think it's very likely to be a yawner to a lot of voters, believe it or not. It will be very interesting once it actually gets to the point of a trial, if it, assuming it gets to that point, and then does he actually get convicted? It would be quite salacious that Trump would have to testify under oath. I mean, that would be quite interesting. But until we get to that point, I feel like most voters just like, what's new about this? The thing that is new is that it's a charge being resurfaced that is actually going to result apparently in a criminal charge. But there's a lot more to come that I think is going to be bigger than this.
Steve, Trump and the name itself, the brand, whatever you want to call it, hasn't necessarily been successful in recent elections, whether it be the midterm, whether it be runoffs, or even the general election back in 2020. And so all of that considered, does this even make a dent in how his own party that he's looking to re-establish the attention, or at least the confidence of how they view him?
Well, look, I am one who does not believe in underestimating former President Trump. So that's one element. I think the second element is far more people have sympathy with him potentially being a victim of a politically driven prosecution than do actually support President Trump. So the net ad for him by this drama is greater for him at this moment, and that could give him a boost. And as John Bolton said on CNN this weekend, John Bolton said, hey, we have to have one rule of law for everyone. But if the DA has any wobbliness in his case, in this case, and many people have looked at it and said it's a very hard case to prosecute, then Bolton has said they've likely just elected Donald Trump back to the presidency. I wouldn't go that far, but it certainly creates the conditions where Trump thrives being the victim. And that gives him a net bump and could bring him back into our daily lives.
So, Steve, I'm skeptical of that, and I want to ask you who those voters might be. So the pro-crime Republicans are already Trump voters. That's Trump's base, and they'll stick with him. I mean, is it plausible that Trump would actually convert voters who are on the fence? You know, let's say they're on the fence. Maybe they were prior Trump voters. They said, no, I'm sick of the guy January 6th. He's just descended into this weird conspiracy land. Like, what kind of voter who would not have voted for Trump before might actually vote for him because he got indicted?
It's a great point, Rick. But what I see out there right now is a regional divide of people not liking the New York system, versus, what may play in the South. It may solidify him in the South. And it creates a problem for those people who want to challenge Trump. Because as you know, within the party, Trump is polling at about 30%. He gets 30% everywhere in the Republican Party. Nobody else comes close to that. Not Rick DeSantis, not Nikki Haley, not Mike Pence. And so as they kind of look at that, and now he's created a challenge where he's said to them, you either need to decide you're with me in this legal challenge from New York, which is a political witch hunt again, or you're against me. And that runs the risk of diminishing their. So it's not the question of net value added this. It's a question of in 15 rounds, who's there with him? And is this an opportunity yet again for him to knock out and diminish others? Even though I agree with you, it's very hard to see how he adds up upon where he is. But if he's the flavor of ice cream that they get at the end of the day in their primary process, because of the use of these sorts of moments, then I think he's stronger than you may think he is.
So one point I think is worth making here is the 2024 election on the Republican side going to be only about Donald Trump and all the possible crimes he may have committed? Do Republicans care about anything else? Do they care about health care? Do they care about immigration? Do they care about crime? Or is this, I just think this is just a gigantic...
I hope they would, but Rick, we've seen
Steve.
a lot. We've seen a lot of vapid campaigning. I'm all for issues. You and I both are. And I think I don't want to demean anyone in any political party, but those, I do think at the end of the day, Republican voters, what's that?
I just said, why wouldn't you want to demean anyone in any political party?
Well, because, basically, you got to say, hey, there are issues and then there are character issues. And what we see is less and less focus on issues like debt, like crime, like the economy, like global trade, all of the issues that Rick maybe at the state of education in America and on and on. And those do matter to a substantial portion of the electorate. But there's also this performative insanity that we see that more and more candidates are picking up to drive their candidacies that has nothing to do with issues and has other to do with invented drama, like maybe this moment. And I have to say, Donald Trump is the best at it.
There's one name I don't think we've even mentioned thus far in this conversation, and that's Joe Biden, the guy who, if indeed you're correct and Trump gets, enough noise around him to get the nomination again, it seems the conversation on the other side is really centered around one person. And it's early, Steve, but does that person have a chance if we have another matchup? He said he does.
Look, I think that Joe Biden has a lot of strengths. They've accomplished a lot, even in the last Congress. They've brought and marshaled a lot of things. For some reason, not a lot of it has seeped through to the American public where they realize it. I think it's going to be, a neck and neck race. I think Joe Biden has enormous strengths if he's able to pull it out. But I think there are substantial doubts in Biden as well on a lot of fronts that I don't want to get into. But I do think that that it's not a slam dunk for Biden if it's a matchup between Donald Trump and Joe Biden again.
Biden was not a superhero candidate in 2020. He did win. Why did he win? Because he offered to bring normalcy back to the country. So look at everything we're talking about here. Let's say this is how this setup ends up in 2024. Biden is running the country. He's signing laws. He's I would hope helping Ukraine defeat Russia in that war, and kind of managing things. And here comes the Trump chaos machine. So I mean, this can only seemingly help Biden. I do not think he's going to be a strong candidate in 2024, but he overperformed in 2020, and in large part because Trump helped him. I mean, people did vote against Trump to help Biden get elected, and that could be the same thing that happens again in 24.
I don't know. Shrug is my prognostication on all of this. Steve, we got to leave it there. Rick, we got to leave it there. Steve Clemens, Semaphore founding editor at large. Thank you. This was fun. And also our Rick Newman. Let's check back in on Treasury Secretary Janet Yellen. She did just conclude her remarks before the American Bankers Association in Washington, D.C. But in terms of what she said, in addition to the comments that we already brought you, she talked about the catastrophic impact of the arguments over the debt limit, which is also part of the political conversation we didn't get into. She said that brinksmanship causes substantial harm. She also said having a sustainable fiscal path is our priority. And she said preventing a default, that is of the U.S., is a basic responsibility. So really hammering home that debt ceiling issue here.
Absolutely. Well, coming up, thriving amid the turmoil. There's a slight pause in the Bitcoin rally, but 30,000 still doesn't seem out of sight here. Are the principles of decentralization more important than ever in the wake of SVB's collapse? We'll discuss that next. Bitcoin, BTC, USD hovering around $28,000 after hitting its highest level in 9 months as investors look to the Fed decision as the next key benchmark. Yahoo Finance's David Hollerith joins us now live and live in color from Nashville, Tennessee. David, what are you tracking with Bitcoin right now? And can we push through that $30,000 mark, do you think?
Well, Brad, if you look at the futures market for Bitcoin, the strike price, the highest level of strike price is at the $30,000 mark. The highest amount of expirations is for the end of March. So there's definitely, I think you could say the majority of at least long positions are looking for that $30 mark. It has been interesting, just given that last week Bitcoin saw one of its highest weekly gains on record. And so the cryptocurrency's price has been mostly consolidating leading up to the Federal Reserve's decision on Wednesday. And, just to give you an idea of where we came from, this rise we saw last week was effectively from $24,000 to this $28,000 mark. Now, for the last 2 days or so, Bitcoin has kind of been hovering around that. And the big question here is how much the banking crisis is playing into this, and whether or not people are moving to Bitcoin as a safe haven asset. And that question is honestly very difficult to prove, and I would argue not provable yet. So we also obviously have the Fed potentially, giving a 25 basis point hike or even less at this next decision. So that's also very good for risk assets, or better than what could be. And I wanted to point out, too, that since FTX has collapsed, and also more recently Silvergate and Signature Bank have gone offline, liquidity, or sometimes called market depth, for Bitcoin has dropped across exchanges. Research firm Kaiko has pointed this out yesterday. And this has been such a substantial drop that what it means is that price or orders on Bitcoin, whether they're buy or sell orders, can more easily influence the price movement of the asset. So that's definitely something to watch for, especially on weekends when trading is lower. So that might have a little bit to do with what's going on with these movements. I don't know if you've noticed them, but even when we say tight trading range, Bitcoin's been relatively more volatile than it was, towards the end of last year. But that being said, Matrixport, another firm, has sort of put out that in this most recent rally, U.S. investors appear to be sort of the majority investor, regional investors who are buying Bitcoin. So that's obviously something interesting to see. Again, not going to find an answer on Wednesday about no matter what the Fed does about whether or not investors are looking to it as a safe haven yet.
No, but we'll be able to watch the price action at least. Thanks so much, Dave Hollerith. Appreciate it. Tesla's credit rating was Ba1 or junk status, according to Moody's Investor Services at the end of January. But yesterday evening, the credit rating provider upgraded the EV maker to Baa3. That's its lowest level, but it is investment grade, I should say. Some investors say it should be much higher based on Moody's own calculations. S&P Global upgraded Tesla's credit profile to investment grade in October, noting its EV market leadership and manufacturing efficiency. With Moody's, the reason Tesla wasn't upgraded sooner may be Tesla's CEO, Elon Musk. Yahoo Finance's Pras Subramanian has the details, and all of this has to do with the debt that Tesla issues and at what price. That's why these ratings are important.
Right. So, Tesla basically entering the blue chip world now, right? Following this Moody's upgrade to, like you said, Baa3, I believe. This, also citing a lot of what S&P said too, market leadership, able to build cars cheaper. They're had the top footprint with regards to EV manufacturing. But yes, this is important because when two ratings agencies give you that investment grade status, you get that blue chip status, means cheaper to issue debt. You can issue it more cheaply, more access to capital. And that means certain investors like pension funds and things like that can actually buy your debt. And that's good for Tesla. I'm kind of surprised why this didn't happen sooner, right? Because S&P did this in October, and Tesla's had several quarters of profitable growth. They're like I said, a top 10 company by market cap right now in the U.S. Very little debt, decent cash position. So and industry best margins. So it's not surprising this happened, but why it took so long, who knows?
Well, Tesla also appears to be gaining traction in Europe. What can you tell us about the EV makers' growth abroad there?
So the European, the main automaker association said that Tesla had around 19,200 registrations in February, which is up around 1% compared to last year, but it's over 20% more than from a year ago. So good news there for them. Europe's a bit different. It's a more competitive EV marketplace. In the U.S., Tesla has around 60% of the market share, and in Europe it's around 20%. But you got cheaper offerings from Stellantis, you got VW there, so it's a bit more competitive. But it shows that Tesla has some brand cachet still in Europe, and also the recent price cuts that they instituted are working there as well.
Interesting.
Yahoo Finance's own Pras Subramanian tracking all things Tesla. Thanks so much, Pras. Appreciate it. Guys, coming up, how the banking turmoil is impacting energy markets. We're going to speak with an expert. That's next.
unrealized losses.
The unrealized losses.
We've been hearing the term unrealized losses a lot lately, but what does that mean? It's basically losses that are on paper. If you have an asset on your balance sheet as a company, an institution, it fluctuates in value, right? Because it's something that is pegged to the market. If that asset has gone down in price on paper, that is on your balance sheet, you have recognized a loss, an unrealized loss. That loss only becomes realized when you have to sell that asset if the price has gone down. One maybe easier way to think about it is to think about a real asset that might be on your personal balance sheet, like a house, for example. Let's say that you buy a house at $300,000 and you live in that house for a while, but then something happens in the housing market. The price of the house goes down a little bit, say to $250,000. That means it's an unrealized loss. You haven't sold the house, you still live in the house. If something happens and you're then forced to sell that house, you take a realized loss. That unrealized loss becomes realized because you've made the sale. But let's say you live in that house for a while longer and the price goes up. Well, then you don't have an unrealized loss anymore. You actually have a gain. So that's how we can think about these various issues. These losses don't become realized unless, like some recent companies in the news, you are forced to sell for whatever reason.
Energy markets climbing back from yesterday's lows as the heat from bank turmoil separately eases. Here with more on all of this, we've got Paul Bayaki, who is the SS&C Alps Advisors Chief ETF Strategist. Great to have you here with us in studio. Perhaps we start on the banking turmoil that we've seen play out, and especially as you think about some of the ETF exposure that people may have in their portfolios right now.
Yeah, so I think what this has opened people's eyes to is their sort of unknown or unexpected bank exposure. So you look at, for example, a Russell 2000 ETF, it's got 9% in regional banks. If you look at a Russell 2000 value ETF, it's got 18% in regional banks. And so it's forced people to maybe reconsider and reconfigure some of their exposures. We saw a graphic when we were in the green room looking at XLF, which is, of course, a portfolio of larger banks. It had 0.17 exposure to Silicon Valley Bank. So if you're thinking about your financials exposure, what we're hearing is depositors from some of these smaller banks are starting to move their money to some of the larger banks. And we're also now seeing, from an investment perspective, people moving their investments from regional banking strategies into XLF or a large diversified financial services portfolio.
Do you think that that is going to bounce back in the other direction at some point? I mean, there's also been a lot of sort of vocal defenders of regional banks, right? And including Janet Yellen today, who was talking about the need to support small and mid-sized banks. From an investment perspective, though, do you think the ship has kind of sailed? Like, how often do the flows, once they leave something, do they come back?
Well, I think we're in this period now where people are trying to understand what happened with Silicon Valley Bank and Silvergate and some of these smaller banking institutions and understand how could this play out in this way. And the reality is that unless you're a bank analyst getting into the nitty-gritty of your held-to-maturity exposure, your for-sale securities, et cetera, and the impact of interest rates on the various components of your balance sheet, it's hard to know. And so, yes, I do think that, as we saw on the tape yesterday, there's been a rebound in confidence in some of these regional banking exposures. But the reality is that if you're a very wealthy individual and you've got money on deposit at the bank, in theory, that's the safest thing you do with your money is just deposit it at a bank. And people are waking up to the idea that maybe there's some leverage embedded in that process that they didn't understand or that they didn't quite comprehend. And being at a larger institution is peace of mind for some of these folks.
And so that's kind of what we've continued to hear about with regard to the systemic issue for some of the regional banks, or at least the banks that have been hit hardest amid the turmoil and in some cases have collapsed or had assets seized. Is that kind of mediated or remediated for a lot of the other players in this space? And I guess in other words to say, what is to say that this does not happen or have a broader kind of ripple effect across other banks?
Yeah, so coming into 2022, I think a lot of folks were bullish on the financial sector, maybe even banks, because the thought was when rates go up, net interest margins improve, banks tend to make more money because they borrow short and they lend long. The reality is that in the case of Silicon Valley Bank, it was the opposite. Net interest margins went the opposite direction because the money that they were loaning out through the form of bond investments had gone down considerably in value, and they had this ramp up in deposits at higher yields. So I think going forward, people are just trying to think about, I have to have exposure to financials just to be sort of fully exposed to the market, but what other segments of financials are going to work? Capital markets, insurance, et cetera. So for example, I mentioned small caps. Our small cap ETF has 20+% in financials, but it doesn't have any regional banking exposure because it screens for quality, it screens for low volatility, dividend growth, et cetera. So it ends up having capital markets and insurance exposure as opposed to regional banking exposure. And I think by and large, why people are moving to something like XLF and financials is because JPMorgan, these large banking institutions, yeah, they have that traditional lending business, but they have capital markets activities, they have trading activities, they have a diversified revenue base.
And then there's all the sort of trickle down, ripple effects from what's going on with the banks. And we mentioned energy at the top, which is not, there's a lot going on with energy markets right now. It's not just this, but when you see these sort of risk aversion causing shocks to the market, lately, really we've seen a lot of money come out of oil. And then even though people like oil stocks this year, oil prices are not cooperating.
Yeah, so last week, at the end of the week, we got the leading economic index, and that data was pretty bleak, right? And most of the indicators in that are at the very least showing signs of stress in the economy. And I think the market has been focused on the demand side of energy, which has been dragging it down. And the reality is global energy markets are still very tight as a result of the Ukraine conflict and just coming into this cycle, the fact that there has been underinvestment in production globally. And so energy companies, if you look at those within XLE, for example, are still extremely cheap just on a valuation basis relative to where they were even at the beginning of this rally. Energy was the best performing sector in the market the past 2 years running. And so you look at the top of the food chain in energy, these companies have free cash flow yields in excess of 10%. So valuations have actually come down despite having rallied 100+% over the course of the past couple of years. So in some ways, this is a short-term market reaction to concerns about a recession and the impact on demand, perhaps overly worried about what that demand side is going to do relative to a supply side of the market that's very tight globally.
And is there any percentage of that also factors or prices in an energy transition as well that we've been talking about?
Yeah, and as we've talked about previously when I was on the show, the energy transition is this massive, meaty megatrend.
Multi-year, 10-year plus.
And the reality is that we're going to need a lot of natural gas to generate the electricity to meet the demand for electric vehicles, as well as the transition away from gas stoves and homes, et cetera. And so the reality is that investors who want a position for that probably need some combination of legacy energy exposure along with renewable energy exposure to position for that, perhaps in addition to carbon credits exposure and even raw materials exposure, lithium, nickel, cobalt, et cetera, that goes into these things. And so in many ways, this is a short-term opportunity for some folks who were concerned that energy had run too much and were sort of scared that they had missed it. And because valuations are still reasonably low relative to history, of course, and fundamentals have been so strong, I think to your point, the investors who are selling energy might be in some ways overreacting to some of the concerns about economic activity going forward.
Yeah, XLE down about, 9% so far this year. Paul, good to see you. Thanks for coming into the studio and visiting us from Denver. Appreciate it. Paul Bayaki is SS&C Alps Advisors Chief ETF Strategist. Thank you. Coming up, the space race continues. Rochelle Akubo is going to speak with the CEO of the company that issued the first pure play space ETF. Stick around. We'll be right back. have some big interviews on tap on Yahoo Finance today. Rochelle Cuvo is going to speak with a professor from Columbia Business School on what led to the downfall of Silicon Valley Bank.
Big discussion there, plus the rise of the robots. The CEO of Nightscope going to join in the next hour to discuss how companies are adopting artificial intelligence into office security.
And don't miss our 3 to 5 p.m. show with Shauna Smith and Dave Briggs. They're going to break Nike earnings, and they're going to talk to Barclays' Adrian Yee following those numbers. Before we leave you, should we check on the numbers?
Let's check on the numbers
Let's check
here.
on the numbers. What's going on in the markets right now? We have stocks hanging on to gains, but paring them back.
They are. We've got major averages in the green across the board right now, but of course off of some of the session highs that we saw when all of the major averages were up a little bit more than 1%.
Yeah, Rochelle Cuvo's got you for the next hour. We shall be back tomorrow. Have a good one.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Cuvo. Here's a look at what I'm watching this morning. First Republic leading the S&P 500 higher amid a broader rebound. The FDIC and Fed reportedly exploring ways to increase bank deposit guarantees. This, as Janet Yellen says, the Treasury stands ready to intervene if more small banks run into trouble. And walking the tightrope, fighting inflation is hard enough without worrying about imminent risks to the financial system. Now, it's not a great position for the Fed to be in ahead of a crucial rate decision tomorrow. We'll look at some conflicting forecasts. And political risk. Donald Trump says he could soon be arrested as soon as today. The possible indictment stems from his alleged role in payments made to an adult film actress during his 2016 election run. We assess the impact on the 2024 race. But first, let's take a look at how the major indices are faring. We're seeing that all three are in positive territory, though we are seeing a little bit of a slowdown here in some of the buying action. The Dow, though, still up more than 200 points. The Nasdaq Also up as well, about 0.5%, and also taking a look at the S&P 500, up 0.6% on the day as well. Let's also check in on what we're seeing with treasuries, because a lot of people wondering about the flight to safety is a slight pullback ahead of the Fed decision. We're seeing the 5-year there up, gaining strongly. They're about 3.2%, the 10-year up more than 2%, and the 30-year up 1.33%. Well, U.S. officials reportedly reviewing ways to expand the FDIC's coverage on deposits without formal consent from a divided Congress. That's according to Bloomberg News. But how does the U.S. insurance cap on deposits stack up against other countries around the world? Here to break it all down is Yahoo Finance's Ines Ferre. Hey, Ines.
Hey, Rochelle, that's right. And that FDIC insurance is $250,000, up to $250,000 that depositors can get back if a bank goes under. Now, when SVB went under and also when you had Signature Bank closing, regulators came in and said that depositors would be made whole regardless of how much money they have. But how does that $250,000 limit stack up against other countries? Well, we've got a full screen for you so you can see where we're at. And it looks like the U.S. has the most deposits that are insured, 250,000, with Australia's deposits coming in at 167,000 that are insured. European Union, if you have up to $107,000, that is insured. And then in China, up to 500,000 yuan or $73,000, and Canada, $73,000. Now, this measure to perhaps expand this in the U.S. would be to continue to shore up confidence in the banking system. Remember that over the weekend, on Sunday, the Fed announced that it was going to do swap lines on a daily basis with other central banks. We've got a chart for you showing you those other central banks. And that's so that liquidity can keep flowing through the system, so that banks in other countries, a European bank, for example, a smaller European bank, if depositors are concerned about their money, that it's to keep shoring up that confidence, to keep liquidity going through the banking system so that the dollars can continue to flow if the other central banks need dollars in exchange for their currencies. And all these measures are to sort of not just shore up confidence, but in the U.S. in particular, so that a two-tier banking system doesn't arise. Because the concern is that if you have these smaller regional banks that have insurance up to $250,000, if they go under, then, well, depositors are going to want to go to the bigger banks, the too big to fail banks, the banks that the government will definitely back. Rochelle.
All right, thank you, Ines Ferreira, with that update. Well, U.S. banks were sitting on $620 billion in unrealized losses at the end of 22. That's according to the Federal Deposit Insurance Corporation, or FDIC. However, research from several academics now finds that the U.S. banking system accumulated $2.2 trillion in these unrealized losses over the past year. That's as much as 4 times the number presented by the FDIC. Now, these researchers also found that 10% of banks have had larger unrealized losses than SVB. So just how much risk is in the U.S. banking system? And are more bank runs on the way? Well, joining us now to discuss is the co-author mentioned in the research, Columbia Business School professor and research associate at the National Bureau of Economic Research, Tomasz Piskorski. Thank you so much for joining me, Tomasz. So, when you look at the number of banks that were in a similar position to SVB, talk about why those didn't fail versus what we're seeing the fallout for SVB.
Yeah, thank you for having me on. So we did the first academic study on looking on how the recent rise in interest rates affect the market value of assets. I just want to mention 3 of my co-authors. It's together with Erika Jiang, Gregor Matfos, and Amit Seru. So I speak on behalf of the team. So what we find out, you have to first understand that U.S. banks are very thinly capitalized. Typical U.S. bank is about 10% of equity. So 90% of its funding comes from various debt instruments, predominantly deposits. And based on our analysis, the assets of the banks are about $2.2 trillion less. And it's mainly also the big difference between the number you quoted comes from taking into account also the assets they held to maturity. Think about the loans like real estate loans or corporate loans. So why SVB failed? So if you just look on current capitalization of US banking system, about half of banks actually have the market value of the asset less than the face value of liabilities. So you would conclude from this test that about half of banks are in trouble. Of course, this is a kind of an extreme view, because it really all depends on the behavior of depositors on the deposit side. If most of banks are predominantly financed with insured depositors, they don't care about the risk of default of the bank. And as long as they're okay getting a very low deposit rates, that doesn't really create much short-term trouble for banks. The problem is, and here as Silicon Valley Bank comes, about more than 37% of bank liabilities are uninsured deposits. There's about $9 trillion of them in the system. And these depositors really are not insured in principle, and they should care a lot about solvency of the banking institutions. And they can also be much more sensitive to interest rates. And Silicon Valley Bank was essentially a bank that's not as bad as some of the other banks in terms of its realized losses, but its funding was predominantly uninsured deposits.
And according to your research, more than 78% of SVB's assets were funded by uninsured deposits. So that really does put it at least in the minority in terms of the proportion there. But of the banks that do face the same risks as SVB, which ones are considered systemically important?
So we looked on, we essentially did a stress test of the banking sector. How many banks can actually survive uninsured depositor run? So first, the first scenario we consider, imagine at each bank, 50% of uninsured depositors withdraw their money. In this case, we'll have about 190 banks being in a precarious position, meaning that the remaining value of assets is not enough to cover the face value of the insured deposit obligation. And these banks account for $300 billion. But of course, if such run become more pronounced and wider, so we did another stress test, what if 100% of uninsured depositors withdraw their money at each bank? Then we have a very different situation. We'll have almost more than 1,600 banks being essentially potentially insolvent, and they account for $5 trillion of assets. And in this group, you have some very large banks.
And so talk about some of the banks within there, although we know obviously everybody is not going to do a bank run at the same time.
So, I don't want to give specific names because the last thing I want to do on your show is start a bank run. But among the largest top 10 banks are really some large financial institutions. So there is a significant risk to the system. And of course, you could say this is somewhat of an extreme scenario, 100% of uninsured depositors withdrawing the money. But I think what really our paper tries to make a point is that because of a large increase in interest rates and how thinly capitalized banks were to start with, about 10% of the funding comes only from equity, there is really a significant increase in risk of uninsured depositor runs in the US banking system. That's something regulators should really think about.
So, Tomas, when the unrealized losses did start to mount, inflation was peaking, you saw the Fed hiking interest rates. How did some of these banks really address the risk then, or did they really not?
Now, by my understanding, they didn't really hedge much of this risk, and they were kind of catch off guard when interest rates start rising. In some sense, this is the core of the banking business. They engage in maturity transformation. They invest in long-term assets, often at fixed yields, and they finance it with short-term deposits. I think what is kind of new in terms of the point we were making, and this risk has been building up for many, many years, is that a very significant part of bank funding does not really come from the so-called safe, sticky insured deposits. You have $9 trillion of funding coming from uninsured deposits, and it's big enough, $9 trillion, to potentially create a significant risk factor to the system if these uninsured depositors become nervous about bank solvency, or if just they seek higher yield by, say, moving their money to US Treasuries. And it's obviously puts a potential concern for the Fed in terms of the inflation fighting objective.
And we know that the Fed has sort of highlighted some of this. They noted some weakness in some of these smaller banks and related that to real estate. But then you also have Treasury Secretary Yellen saying, look, they're going to really prioritize stabilizing the banks. But then you have to wonder then, what does this mean in terms of the domino effect on the banking industry when you do start, moving the goalposts on these FDIC limits here versus, say, other countries in the world?
So I think, what administration tried to do quickly, the regulators, is to sort of stabilize the system and prevent this uninsured depositor runs. I think in a short run, it calmed the markets a little bit, but of course, there is a longer question. Uncertainty still remains. And more broadly, after this episode, I think we really need to rethink much more the financial architecture of U.S. banking system, including how it should be regulated going forward. Let me just mention, we have another paper in which we look on what is the capitalization of non-bank institutions. You know, in the residential mortgage market, companies like Quicken Loans are the major lender. And guess what? When these institutions don't have access to deposit funding, they actually retain more than half of capital, more than twice as much capital as U.S. banks. So in other words, institutions without access to deposit funding are much better capitalized and can, in principle, much better withstand a significant decline in the in the value of the assets.
That's definitely an interesting takeaway there. I do appreciate you joining me for your insights. Tomasz Piskorski there, Columbia Business School professor and research associate at the National Bureau of Economic Research. Thank you for joining me this morning. All right, time now to check in on a trending ticker. Shares of Nvidia in focus after the company kicked off its developer conference. The chipmaker's CEO expected to share how the company is accelerating in the artificial intelligence space with breakthrough technologies and solutions. Jensen Huang, Nvidia founder and CEO, will be joining the show tomorrow afternoon to recap his vision for the future of AI. You won't want to miss it. All right, coming up, Fed Chair Jay Powell and company set to meet tomorrow to discuss interest rates. We preview what to expect on the other side of the break. Stick around. Time now for our chart of the day. A Bank of America fund manager survey shows that in addition to credit risks, investors are growing concerned about the economy. Recession fears ticked up in March, showing sentiment on the likelihood of a recession is rising again for the first time since November. Bank of America's survey shows a net 42% of participants expect a slowdown over the next 12 months. Meanwhile, expectations for stagflation have remained above 80% for 10 months in a row. Well, coordinated intervention may have limited contagion risks in the banking system. Still, the noise surrounding what lies ahead for the Fed rate hikes remains unclear ahead of this week's FOMC meeting. Here to discuss is Chris Konstantinos, Riverfront Investment Group Chief Investment Strategist. Good to see you here. And so, this is a tough meeting that the Fed was coming into. Obviously, a lot of unexpected events over the course of the last week and a half. And part of that, though, meant that in bailing out some of the banks, the Fed had to add $300 billion to its balance sheet. What kind of position is the Fed in going into this meeting?
Well, first of all, thank you for having me. And I think even in normal times, I don't envy the job that the Fed has to do, balancing keeping inflation contained and, protecting jobs. But right now, I think this is one of the toughest acts that they've ever had, at least as long as I've been watching the Fed, which has been for a while. Now they've got to figure out how to not just keep inflation contained, but they actually have to figure out how to get inflation a lot lower, at the same time protecting jobs in the economy and now protecting the banking system as well. So I think it's a real tap dance here. And I don't think that I've ever seen the Fed funds future curve or the probabilities change as dramatically in the quiet period before the Fed speaks as I have this past time. So I don't envy Jay Powell and company. I think they have a really tough job to do. I expect that they are going to continue to hike tomorrow, but I think probably 25 basis points. And then I think there's going to be, like I mentioned, a real tap dancing session trying to balance out all of the risks in the Q&A.
And you can really tell that this has thrown a real spanner in the works, because in terms of predictions, I mean, obviously about 2 weeks ago, 50 basis points is probably what people were looking at, and then that sort of tapered down to 25. But now you're saying some people are saying that the Fed should pause rate hikes, should do the 25 basis points, should cut even by, in some instances, some suggesting a 50-point basis hike. What are some of the scenarios if we do end up with just a pause versus 25 or a 50 rate cut?
Sure. Let me lay out what I think is why some of those folks, very smart people, who are saying the Fed should pause or even cut. I think the logic behind that is related to the fact that with this banking crisis, the smaller size lenders that are really at the epicenter of this crisis are kind of the lifeblood of small business lending, commercial real estate lending, et cetera, in America. And I've seen some studies that suggest that the sort of early run that we've seen on some of these banks is the equivalent of tightening financial conditions somewhere between 25 and 50 basis points. So I think that's the logic. Let me tell you, though, why I think that I disagree with that take a little bit. If you look at inflation trends, and we like to dice them up between what we call sticky CPI and flexible CPI. As the name suggests, sticky CPI are the types of elements of that CPI basket that don't change a lot month over month. They're not that volatile, but they're really, really important parts of the consumer spending basket. It's like 70% of the CPI baskets in what we call sticky. If you watch sticky CPI, it hasn't come down at all recently. And I think that's got to be on the Fed's radar screen as a potential concern. So on one hand, they don't want to break the financial system. They want to protect jobs. But on the other hand, they're watching sticky CPI, core CPI, not really do the dance that they want it to do. And so therefore, I think they have to remain somewhat resolute in terms of interest rate hiking here.
And as they do keep sort of one eye on what's happening with some of this banking fallout, now you say that you don't expect the sort of magnitude of a fallout that we saw from 2008, whether it's in terms of the magnitude of it or the economic fallout. What are your expectations then for how this plays out, since this does seem to be living with us for a while?
Sure. So first of all, my backdrop for saying that is the fact that as I look at what I'm calling the bank panic of 23, the bank panic of 23 so far is not a credit crisis. 2008 was very much a credit crisis. There was a ton of really ill-advised loans, mostly related to mortgages, real estate, et cetera, that were hiding on bank and shadow bank balance sheets that all failed spectacularly. Thus far in 2023, I don't see this as a credit crisis. I see this as an interest rate volatility crisis. Your guest a few minutes ago, the professor from Columbia Business School, I thought had some excellent points in his research on this. The idea is that the massive amount of interest rate volatility, unexpected rising of interest rates, has caused a short-term illiquidity issue with a lot of smaller banks who didn't do a good job of interest rate hedging, and you had a lot of uninsured deposits. That is at its core a different type of crisis than a credit crisis. And I think it's one that's actually on some level easier for the Fed and for policymakers to help bolster. Because all they have to do is say, well, you've got all of these government securities that if you held them to maturity, theoretically, they're money good. But because you have this run on your deposits, you can't do that. We're going to step in and we're going to help you take those assets off your balance sheet, off the bank balance sheet, and onto the Fed and the Treasury, FDIC, et cetera. that, in my mind, is a more manageable crisis for policymakers to handle. Having said all that, though, we have to recognize what this is going to do to credit creation in these smaller institutions. It's going to grind it to a halt. And in doing so, that's going to have a chilling effect on the U.S. economy, which is already in some sectors struggling. So I think that we have to be cognizant of the fact that economic growth is going to be lower here than it would have otherwise been prior to this mini crisis, and we have to factor that into to our assumptions of what the future looks like.
So, Chris, what does this mean for the Fed really walking this line then between sort of helping to create some of this volatility while also trying to create stability at the same time?
Yes, I think it means that on some level, I think that the modern Fed has always they've tried to be as transparent as possible. But sometimes forward guidance is not a good thing when the backdrop is so uncertain, right? Just like we talked about a few minutes ago with how much expectations changed during the Fed's quiet window. I think the Fed is going to have to be really careful about forward guidance here and potentially not give a whole lot of it because, they're not omnipotent. They don't know what's coming down the pike. And I think they want to keep their options open. So I think they're going to have to be very, very careful about what types of information they're going to give to the marketplace. I also think that they have to strike this balance of making sure that the public understands that the government is on the case as it relates to these bank runs, and that that they're not going to allow them to seep deeply into the globally systematically important banking system where the majority of deposits now are. But at the same time, they have to convince the market that they're not, giving up the inflation fight. My personal view is if they halted interest rate hikes at this week's meeting, I actually think that risk assets might rally at first, but then might actually panic because now they'd be saying, well, what does the Fed know that we don't? If they're going as far as to give up their fight on inflation here. So I actually think that they have to strike a balance. I think if their message is too far towards price stability or too much towards financial stability or inflation stability, either too much in either direction, I think is going to be tough for the market to take. So I think they have to be very, very balanced in their statements.
Certainly wouldn't want to be Jay Powell in this situation. I'm sure every word will be being passed through. Chris Konstantinos, thank you so much. Riverfront Investment Group Chief Investment Strategist, thank you for your time this morning. All right, checking here on the markets here, sponsored by Tasty Trade. We're seeing the Dow there still in positive territory, up 0.6% there. We're seeing the buying action picking up. The Nasdaq also seeing strong gains, up 0.8% on the day. And the S&P 500 in similar position, up 0.8%. That rebound in regional and big banks certainly helping push up all the major indices. All right, well, the Supreme Court is taking on its first crypto case, and it involves a major exchange, which is Coinbase. The justices will hear arguments stemming from Coinbase's efforts to push 2 lawsuits into arbitration. We have Yahoo Finance's Alexis Keenan here with the details. Alexis, what's the latest?
Hi, Rochelle. Yes, so the Supreme Court for the first time taking on a crypto-related issue. And this issue that they're tackling today, it's a bit of an esoteric one. It's a legal issue involving legal procedure. But let's try to break it down here. This case, it stems from 2 different class action lawsuits that were brought against Coinbase. And the plaintiffs here in both cases, they were able to sidestep Coinbase's user agreement. And what that user agreement says is important to a lot of users and a lot of plaintiffs that have tried to go after the company. It says that all disputes between users of the platform and the company must go to arbitration and therefore not into a court of law. A California court, nonetheless, a federal court, agreed to hear the disputes. And in response, not surprisingly, Coinbase then filed an immediate appeal asking for the appellate court to step in and stop these litigations from going forward while the appellate court would rule on this intermittent issue. So the question here is, can these cases keep going in these lower courts before the appellate court rules on whether or not they're going to kick it out of the justice system altogether? Now, more broadly, though, if we step back, this case has some major implications, not just for crypto companies, but also for tech companies and other companies that use these types of mandatory arbitration agreements. One, though, the mere fact that the court is taking up the case at all shows that perhaps they're willing to go in and take on some other cases involving cryptocurrency. We'll have to wait and see what the court does there. But second, these user agreements that mandate arbitration for the people that use their platforms, oftentimes for free, they're widely used by tech companies and often favor the companies over users. Users don't fare very well, as the statistics show. When they go up into arbitration, the numbers are overwhelmingly in favor of the companies. And so that has been a sticking point and a frustration for users who have, in the case of these plaintiffs, one of them lost $31,000 on the platform because of a scammer who hacked into his account. The other one is alleging that the company ran an unfair scheme for a sweepstakes where they believed they had to buy Dogecoin in order to participate. But the broader implications here are absolutely that these lawsuits could become more expensive, these claims more expensive for these companies, because certainly Coinbase and others don't want to spend their time and their dollars fighting in court when they have provided in their agreements that they would like these cases to go directly to arbitration. Rochelle?
We'll certainly be keeping an eye on that, see if other companies end up perhaps changing some of their arbitration policies depending on that outcome. Alexis Keenan there, thank you for that update. All right, coming up, is an arrest or indictment nearing for former President Donald Trump? And if so, what's the material impact? Stick around, we'll discuss that next. An indictment for former President Donald Trump could come today. Yahoo Finance's Rick Newman is tracking the story and joins us now. Hey, Rick.
Hey, Rochelle. I lost the sound there for a second, but what seems to be happening here, this indictment from the Manhattan District Attorney possibly coming this week. I actually don't think it's coming today. Trump said that over the weekend in a social media post. But the grand jury that would issue this indictment is not actually meeting today, according to press reports. So it could be tomorrow, it could be later this week, it could be next week. It doesn't really matter the timing so much. The Manhattan DA has been looking into this for 5 years. And it does appear that this is going to be the first time that any prosecutor ever indicts a former president or a sitting president. So that, of course, would be a big deal. But this is really just, it looks like it's just going to be this one charge relating to this hush money payment. That goes all the way back to 2016. We know all about that from a lot of reporting about that. The only sort of loose end with regard to that hush money payment was anybody ever going to charge it as a crime? And that appears to be what the Manhattan District Attorney is about to do.
We'll certainly be keeping an eye on that. And as you mentioned, it may not even come today, but we'll keep an eye on that. But also looking abroad, Chinese leader Xi Jinping meeting with Russian President Vladimir Putin. What can we expect to come out of that?
Well, there's been a lot of pomp and circumstance with that visit. Vladimir Putin, the Russian president, he needs a boost. He's having a pretty bad year. His war in Ukraine is going poorly. Last week, the International Criminal Court charged him with war crimes. So one thing Putin gets out of this is he is having a high visibility meeting with a global leader. China, like Russia, is a member of the permanent member of the Security Council, United Nations, obviously a global power. More important, though, than the showmanship is that Putin is probably asking Xi Jinping for China to supply weapons that Russia can use in Ukraine. This is something the United States has been warning about. China might be considering doing, and one would have to imagine that this is probably at the top of the list of anything Putin would ask Xi Jinping for. So here in the United States and in Europe, both sides and almost all of Ukraine's allies warning China, don't do it. You don't want to end up on the losing side of this war. Pick your allies carefully. But Xi Jinping doesn't listen to the United States or Europe all the time. So we'll see what happens as he goes home. And also, it sounds as if Putin may be traveling to China. So both sides here, despite the war in Ukraine, basically affirming this partnership that may be getting deeper.
Indeed, and especially since the US was not able to travel to China for that meeting with Xi Jinping, of course, due to Balloon Gate. So see how sort of these moving sands are going for some of these major powers here. Thanks, Rick Newman there.
Thanks.
All right, coming up, Virgin Orbit is searching to secure a funding lifeline and avoid bankruptcy. A new report suggests they might have found a match. Stick around, we'll break that down for you next. After going public in late 2021 amid the excitement of a new space race, rocket builder and small satellite launcher Virgin Orbit is now in deal talks to avoid a bankruptcy. That's according to reports from CNBC. It says Virgin Orbit senior leadership held talks with investors throughout the weekend. People familiar with Virgin Orbit told CNBC one possible buyer balked at a proposed sale price of nearly $200 million, which is just below the company's market value as of Friday's close. Now, if the company can't find a buyer, a bankruptcy filing could come as soon as this week. During an all-hands meeting last week, Virgin Orbit CEO Dan Hart told employees that the company hopes to give an update on the situation as soon as Wednesday. However, analysis by CNBC finds that many of Virgin Orbit's roughly 750 employees are already looking elsewhere for openings as Virgin Orbit prepares its restructuring plans in the event of insolvency. Well, staying in that space, more than 50 companies, including some defense, pharmaceutical and tech firms, are visiting Vietnam to discuss investment and sales opportunities as part of a business mission organized by the U.S. ASEAN Business Council. Now, notably, this is the first time in nearly a decade that aerospace firms are in attendance. The business mission could be a major driver for space companies otherwise restricted from doing business in certain countries. Joining us now to discuss is Procure AM co-founder and CEO Andrew Chanin. Andrew, good to have you on the show. So obviously, with this being a decade since they've had this sort of meeting here, what is at stake here in terms of the timing and also the goal of this meeting?
Right now we're seeing countries scrambling to shore up allies around the world. And the U.S. can't just sit by and allow allies or would-be allies to cozy up with potential adversarial nations. And Vietnam is one that U.S. has enjoyed a very long positive relationship with over the years. But that said, Vietnam is one of their strongest military partners as far as military equipment supplies over the years has been Russia, a country that's certainly been in our spotlight for more than the last year, but very heavily recently. Although it doesn't seem like anything will get done immediately because there are so many concerns when doing various trade deals dealing with important security, technology, or military capabilities. But this is a big step forward for the U.S. showing that they want to open their arms to Vietnam even more.
And obviously, I mean, you have some of the big players, Boeing, Lockheed Martin, stepping in for supplies on things such as helicopters. But I also want to talk about the space race, because you have SpaceX also going to be in attendance there. Could this be some sort of a pivotal moment or really a setting of the scene for what might happen with the new space race?
We've already seen the space race developing before our eyes, and it happened well before the Ukrainian invasion and is ramping up even more since. And so the U.S. takes security and national defense extremely seriously. And as we've seen more screening out of countries that U.S. firms are allowed to do business with, we're also realizing that we don't want to live in a world of isolation. And not only can this be beneficial to expand our partnerships, relationships, and who we do business with, for military and political purposes, but these can be great boons for this entire space industry. And historically, space has been a very collaborative industry. If you just look no further than the International Space Station, where regardless of what had been happening on Earth for a very long time, we've seen great collaboration in space. And so to completely raise walls and shut off communication in this industry would potentially be a long-term negative, for what could this industry become. But this is a huge sign of showing that U.S. relationships expanding to neighbors of potentially adversarial nations are something that the U.S. is taking very seriously.
And I want to ask you about your ETF, ticker UFO. Talk about the holdings you have in there, because it does include Boeing and Lockheed there. What sort of investments are you seeing? How keen are investors at the moment?
So, space has been an industry that's been volatile, just like many other kind of thematic industries, but it's one that shows major importance and also some interesting catalysts. So, even private companies that aren't in the fund like SpaceX have done things with reusable rockets that have lowered the cost of access to space, which frees up new clients to come into this industry that maybe it was cost prohibitive before. And as they drive down prices, other rocket companies are coming out and they're creating solutions and driving down prices. So we have launch companies like Rocket Lab. We have companies like Boeing and Lockheed Martin, which have a joint venture called the United Launch Alliance. That's also a major launch provider around the world. There's communications companies, there's satellite manufacturers and operators like Maxar, which most of your audience is probably very familiar with being announced as being a potential takeover target by private equity at some point this year. There are many companies that are generating real revenues in space today. Many people focus on more of the further out exploration ideas or asteroid mining or colonizing of planets. But there are many real companies today, and UFO gives investors exposure to almost 40 publicly traded companies from around the world specializing in all different areas of the space economy.
And so for those who are interested in investing in this space, I mean, they're looking at some of these geopolitical tensions. You have what's happening with Russia and China, forging closer ties here. What does this mean for the space race and how people can position themselves?
So I think there's a chance that we might see less collaboration between potentially adversarial nations because technology is something that is extremely critical when trying to separate your capabilities from potential opponents. That said, we are seeing a huge interest in space spending and contracting from the US government, the DoD and military, as well as foreign nations as well. So if Ukraine and Russia was a wake-up call for anything, it was that space is now more critical than it ever has been for our nation and for the globe. And so still collaborating with allies to expand our capabilities will be important. But we are embarking on this new space race 2.0, where it's no longer the USSR versus the USA just saying, hey, look what we can do, and more of a vanity project. These are now critical national security and defense priorities. We're seeing significant contracting coming out. And in many cases, it's to believe that U.S. companies will receive a bulk of those contracts due to national security concerns. So to the extent that the U.S. government wants to continue down its path of fending off adversaries by outspending them, space is a domain that they've seen as the strategic high ground. So we're in the camp that believes that the U.S. takes space very seriously. It's not one side of the aisle that wants to see us succeed here. And it's something that we're seeing collaboration within the U.S. as well. So we're really encouraged. I think nations are starting to take this as an extremely important priority for themselves. You either have to be independent and have your own capabilities, which for many smaller nations is almost cost prohibitive, or you have to find who your ally is going to be and really make sure that you can continue to build on those relationships so that you have that partner in the future for all your space capabilities as well.
And we'll certainly continue to watch this as we figure in things like supply chains and collaborations in those places and what that means for the space race as well. Procure AM co-founder and CEO Andrew Chanin, thank you for your time this morning on Yahoo Finance. All right, coming up, retailers facing pressure to cut down on both labor and theft are turning to robot security in the hopes of solving both. We talk with the CEO of Nightscope. Stick around. Bringing out the bots. Home improvement retailer Lowe's rolling out Nightscope robots at locations in Philadelphia. This according to the Philadelphia Inquirer. So as we take a look at that, I mean, we're seeing retailers are already facing pressure to cut down on both labor and theft by turning to robot security in hopes of solving both. But will robots be enough to turn the tide? Here with more is William Santana-Lee, Nightscope Chairman and CEO. Thank you for joining me this morning, William. So talk about this plan to really disrupt this $500 billion security industry.
Well, greetings from Silicon Valley. Thanks for having us. It's an exciting time to be developing brand new cutting edge technologies and taking all the crazy stuff that Hollywood have been streaming out and actually putting it in the real world. So Nightscope, we build autonomous security robots, as you mentioned, and these are intended to not only deter negative behavior, but just physically being there, you can stop a lot of nonsense from happening, but to give officers and guards really smart eyes, ears, and their voice on the ground in multiple locations at the same time. And the math problem the country has is basically there's about 2.5 million law enforcement officers and security guards. They're running 24/7. So at any given time, there's only maybe 600,000 plus humans trying to secure 334 million Americans across 50 states with the technological equivalent of a number 2 pencil and a notepad. And that is the injustice that we're working to fix, to give those brave women and men in uniform new tools so they can do their jobs much, much more effectively.
So, William, obviously this will end up being a deterrent if you do see it there, assuming you know actually what it is. I mean, will there be some sort of postage around so that people know that that's what this is that would actually deter them and be more of a security provider there?
Yes, that actually is right on point. One of our clients who just renewed for the 6th year did exactly that. If you put security or police on the side of it, it might greet you, it might make a sound. I mean, it's 5 foot tall, 400 pounds. It's roaming around on its own, fully autonomous, level 5, hands off, not remote control. The strobe light's going, you have no idea what it does. You're probably going to think about maybe stealing the car down the street and not there. And that's literally what we've been seeing with our clients. If you go to nightscope.com/crime, you can see the long, long list of positive things these machines have already done for society.
So I want to ask about why you're starting with Lowe's in terms of sort of having it in this big retail space, and why Philadelphia? Why was that the test ground for this?
Oh, it's not the test ground. We've been operating now since 2015. We've done more than 2 million hours across the country in full operation. Our clients are anyone from not just Lowe's, but ABM, a big facilities management firm that's publicly traded. We also announced PG&E doubled their order later last year to better secure the national grid. Our clients are also, commercial real estate, corporate campuses, law enforcement agencies, residential, parking structures, schools, basically anywhere you might see an officer indoors or outdoors or a guard, typically outdoors, is certainly an opportunity for Nightscope, and as well as numerous casinos and hospitals.
So who do you see as your biggest competitors in this space?
We're certainly first mover advantage. Have scaled across the country, operating across multiple time zones. I think we have an opportunity to work together instead of looking at competition. Our long-term, slightly outrageous goal is to see if we can make the U.S. the safest country in the world. And we applaud anyone and everyone that's working to do that, and not just the humans, but all the technology companies that have been working behind the scenes to improve AI, more compute capability, folks in the marketplace, security integrators, guarding companies. It's going to take a whole lot to turn around the negative $2 trillion impact of crime and terrorism on the U.S. every single year. It's a hidden tax we all pay in blood, tears, and treasure, and it has to stop.
Now, I do want to ask you, because people might be wondering, what sort of data are these robots collecting, or are they sort of just assessing risk? What sort of data is being collected, and where does it go? How is it being used?
Well, since we work for Big Brother and, the robots are coming to kill everyone and take everyone's job, no, just kidding. The data is owned by our clients. That's anything security related. And anything, let's say, machine related or health of the machine is owned by Knightscope. And contractually, that makes it pretty clear where the data resides. And it's intended solely to be used for public safety, and it's not to be resold and used in any other manner other than at times improving our algorithms.
And in terms of what we see with retail theft, obviously shoplifting, huge. We saw it picking up during the pandemic. How much of a dent do you think these sorts of robots could make in that space?
It used to be, I think, shrink, stuff leaving the building. Either the patron took it or the employees took it. I don't know. I think it was like 1 to 3% of revenue, not profit, of revenue. I think now some of the clients we've been speaking to is 4, 5, 6, 8% of revenue, literally walking out the door. And I think a combination of software, hardware, and humans, again, to give the officers and guards new, what we call superhuman capabilities at their fingertips, will make a huge impact on not just on shrink, but you have to think about the patrons, the customers coming in, wanting to feel safe. And I don't believe the founders of our country ever expected us to build a society where going to school, going to work, or going shopping literally came with the risk of being shot or killed. And that's why we're so passionate about making a big difference here and trying to get both the public and the private sector to work together to reimagine public safety.
Certainly has been a while since we reimagined public safety. So an interesting space here indeed. William Santana Lee, Knightscope Chairman and CEO, thank you for your time this morning. All right, coming up, we check in on a few trending tickers and get you set for the rest of the trading day ahead of the noon hour. Stick around.
TikTok is on the verge of being banned in the US, meaning your days of endlessly swiping on the platform may be numbered. Of course, there's also a couple of conversations to be had about First Amendment rights, data privacy, and what this means for competitors like Meta and Snap. But let's just start first with how we got here. TikTok wasn't always TikTok, at least not exactly. Back in 2014, Alex Zhu and Lu Yu Yang launched Musical.ly. The app became incredibly popular among US teens and tweens who would use it to lip sync to songs. Sound familiar? ByteDance, meanwhile, was already running TikTok, and seeing how incredibly popular Musical.ly was, decided to vacuum up the company for $1 billion in 2017. It then merged the two in 2018, forming the TikTok we know today. But TikTok's connection to China, coupled with the fact that it's so popular with tweens and teens, sent US lawmakers and regulators into overdrive. It's not as though the app has been without its controversies either. In 2019, it paid a $5.7 million settlement to the FTC over allegations that it violated the federal Children's Online Privacy Protection Act. But the government's main beef with TikTok is over whether it collects US user data, which it can then ship to China and spread pro-Beijing propaganda or spy on Americans. A number of states, federal agencies, and even the military have already banned the use of the app on official devices. Former President Trump attempted to ban the app via executive order, but was shot down in the courts. TikTok then said it would work with Oracle to ensure that US user data is stored on Oracle servers. For its part, the Biden administration has been negotiating with owner ByteDance for months, but the two appear to be at an impasse. Now Biden's throwing down an ultimatum. Either sell the app or get out of the US. If that doesn't work, there are a number of bills circulating around Congress aimed at killing TikTok. It's not as though the US is the only country that's trying to ban the app either. In 2019, India outright banned it from its citizens, and both the UK and Canada have banned it on official devices, as has the EU. Where do we go from here? Well, Trump already failed at trying to ban TikTok, so it's hard to tell whether or not Biden will succeed at the same task. Either way, whichever party does ban it is sure to face backlash from younger voters.
Checking in on a trending ticker here, shares of Nike up more than 1.5% ahead of the retail giant's earnings out after the bell today. The street is expecting to see earnings to decline and revenue to rise on the year. The company also may be getting a boost after its sneaker competitor On Holdings broke out strong earnings and guidance. Also coming up later today, our team will continue to cover the banking crisis and break down what to expect from the Fed tomorrow. They'll also be joined by the CEO of Duckhorn Portfolio, the largest pure-play luxury wine company in the United States, to discuss consumer demand. Now, that will be a refreshing conversation for sure. And of course, tune in tomorrow morning as the CEO of Petco, Ron Coughlin, joins to discuss the company's earnings report as well. All right, well, let's do a final check On how the markets are heading into the noon hour, we see still in positive territory there, but well off the earlier highs of the session. We see the Dow there up about 0.5% on the day, the Nasdaq up about 0.2% there, and also the S&P 500 still seeing strong gains there, up 0.6% on the day. Well, that will do it for now. I'm Rochelle Akufa, but I will be back with you at 11 a.m. Eastern tomorrow. Stay with us on Yahoo Finance.